per monthly base, we think you could easily be in that zone.
Bruce, your update, please, on emerging markets. The currencies give way. I am told conversation after conversation, this time is different. All my radar's up.
Well, I think the currencies give way creates more risk here, especially since we're not going to see the relief on central bank policy. I think where this time is different is in the larger EM economies, and there is certainly a significant problem in low-income economies facing problems with food security and debt dynamics. But in the larger EM economies, you just don't have the debt overhangs, you don't have the current account imbalances, and you have policymakers that have been willing to continue to use fiscal policy. So growth is slowing. EM is certainly a threat if the US and Europe go into recession, and we shouldn't lose sight of the European recession story. But we don't think there's a systemic magnifying effect through credit, which is often the case when you see some of these dynamics take place in EM.
Bruce, where is the leverage right now? Can we finish there? Because whenever we talk about this recession story, you've acknowledged the risks in America, you've acknowledged the risks in Europe, in EM, yet we keep hearing the same thing, that consumer balance sheets are strong, corporate balance sheets are strong. Where do you think the leverage is going to show up?
Well, that's the interesting question, is are we going to see the dynamic on growth, which still has a healthy private sector, sort of cushion here? Is that going to get magnified by credit? It certainly isn't happening yet, but there's certainly signs of stress building. And, I think there's always the underlying point here. When you're raising interest rates and slowing growth, you can be surprised at where something shows up that doesn't seem to be a big story. I would worry about European banks here in an environment in which we're seeing, I think, more sharp slowdown in growth, and we're just getting the ECB going. I'd worry that some of the smaller EM economies show more tendency to spill over in ways we're not expecting from a geopolitical point of view and from a credit market point of view. There are things there, but I'll tell you for sure, I always am surprised where these things show up, but I think we shouldn't lose sight of the context that this is an environment where that's a likely outcome.
Hey, Bruce, awesome to catch up, to get your views on a range of things. Bruce Kasman there of JP Morgan. That was just as good as the commercial break, Tom, just as good as the conversation in the commercial break. This Fed meeting this week is not about this Fed meeting this week. It's about the next one. It always is, September 21. And before we get to September 21st, Tom, you've got an August 10th CPI print, a September 13th CPI print. And I think to Bruce's point there, maybe the labour market's going to take on increased importance over the next 3 to 4 months. August 5th payrolls, September 2nd payrolls. Will this Fed be confronted by slower jobs growth, maybe even negative jobs growth by the end of this year, Tom, as they try and tackle inflation?
You outlined, John, what we are all doing now. We've joined Jerome Powell in being massively data dependent. And we just have to wait to see what the data is. We can guess on it. JP Morgan sub-headlines on Friday that recessions are always disinflationary. Okay, so we've got a slowdown, but are we disinflating down to 7%, 5%, 3%? It's a guesstimate.
Tom and Lisa, I'd love your view on this. I think some people might be screaming at the TV, at the radio right now saying, no. Chairman Powell joined us to be data dependent because he ignored the data for the whole of last year.
I imagine they might be screaming for a whole range of reasons, that among them, and that has been a constant theme. If you're data dependent, what data are you looking at? That's why I'm curious about the ECI that we get on Friday, the Employment Cost Index. How much does that feature into the belief that's frankly hardened into the markets of a Fed pause as soon as next year, even though a lot of people think there's only a 40% chance of a recession in that time?
Because he told us that ECI print was responsible for the Fed pivot at the end of last year. Do you remember?
And the University of Michigan sentiment survey was responsible for the increase that we saw just a few months ago. So which data?
Just cherry pick it and pick whichever one you want. Look, I get the data dependent thing, but as I said a million times last week, Tom, if you don't understand the reaction function, then what's to see here? Which data point matters?
Don't think there's a reaction function coming out of the pandemic, and with the huge fiscal impulse we've had, this is all original.
That's super helpful, then, isn't it? Futures up 0.4 on the S&P from New York. This is Bloomberg.
Keeping you up Up to date with the news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve will probably have to inflict much more pain on the economy to get inflation under control. After raising rates in June by the most since 1994, policymakers are expected this week to approve another 75 basis point hike, and they are likely to signal their intention to keep moving higher in the months ahead. Now, the U.S. says that a Russian cruise missile strike on the port of Odessa has cast doubt on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed after months of talks. Russia says the missile attack targeted Ukrainian military infrastructure. Now, Hong Kong reportedly plans to reduce hotel quarantine for arrivals. According to local media, two-color health code system will be introduced. One proposal calls for 5 days of hotel quarantine. After that, arriving travelers would be issued with the so-called yellow health code for 2 days that would prohibit them from entering high-risk areas. The Swiss bank Julius Baer has reported that net income fell 26% in the first half of the year, while market swings eroded assets that the firm oversees for the rich. The CEO, Philip Rickenbacker, has told Bloomberg TV he thinks the worst is now over. And Apple has announced a rare sales promotion in China. It's offering 4 days of discounts on its top-tier iPhones and related accessories. Apple is usually hesitant to alter prices, but it will cut $89 off the price of the iPhone 13 series. That suggests that there's a surplus inventory. Global news 24 hours a day on air and on Bloomberg. A quick take. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
booked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I've been working to make sure that when the price of oil comes down, the price at the pump comes down as well and comes down in real time. The good news is that's happening, but it's not happening fast enough. We've made progress, but prices are still too high.
Gasoline prices coming down in America every single day since the middle of June. That was the President of the United States, and we wish him well as he recovers from COVID. Futures positive 0.5% on the S&P this morning. Here's the price action for you on the Nasdaq, up 0.5% also. Yields up by 5 basis points, just short of 280, 279.77. The data out of Europe not great again, but the central bank speak remains hawkish. Euro dollar 102.22. Tom, that's positive about 0.1%.
It is. It's what it is. We're resetting here this morning. And John, what do you think? I mean, I've got an equity market lift. I got a VIX at 23.83. It's a bull market.
20% of the S&P reports this week, Tom, across 5 names. I think this week for earnings.
Friday? Yeah.
Huge.
Yeah, absolutely. We'll agree with that, and we'll have all of that, including the big tech companies, for you. Right now in oil, Kevin Book joins us. He's head of research at Clearview Energy Partners. And I would suggest after the heat wave that we've all enjoyed, Kevin, we come back down to what I'm going to call partly July. It's 90 in Washington. Maybe it's 88, 90 in New York. Maybe it's 100 down south where it's supposed to be 100 degrees. How did we do in this heat wave? How did Washington do? Our grids do? Our climate policy do, given a real heat wave?
Well, the hot summer here in D.C. is when lawmakers try to get away. The whole point of August recess is to get out of here when it's hottest, but they didn't succeed in getting out in time. So they have to talk about climate. The climate policy did not stand up to the heat. I'd say it's safe to say that it didn't go where Manchin was expected to go. And so now we're back in the Manchinology game, wondering whether there's one more inning left to play.
Perhaps, Kevin, where climate policy did not go, the price factor did in terms of what people were doing when it comes to driving and the price response to the pump. Why have we seen gasoline prices go down? Is it purely because of the SPR release that we saw? Or is this because people are driving less, they are traveling less, they are consuming less in the face of higher prices?
Well, Lisa, can I say yes? The SPR is a real effect. You can't release 100 and some million barrels of crude oil, not have a price effect. But of course, on the gasoline response, you also have refined product inventories. Where were we a month ago? Mid-June, we were, 7% below demand cover a year ago. We're now 5% as of last EIA data above year-ago demand cover. What changed? The answer is demand. Also, refineries running flat out. So you see both things, a price response and 98% capacity utilization in PAD 1 and PAD 3, the big refining centers at the coast and in the Gulf Coast.
Kevin, how much do you see this as being sticky, as sort of being a continual decline in gas prices versus a pop, just in terms of the knee-jerk response to $5 a barrel, $5 a gallon, I should say, gasoline in the United States?
Well, the refining challenge hasn't entirely gone away. Again, if demand lightens and refineries are running flat out, then you get some balances in those inventories. But watch out for storms, watch out for unexpected downtime. In terms of the crude story, a lot of that has to do with the question of whether or not a price cap truly comes into place. And if not, whether the European sanctions that could drive prices up later in the year come to pass.
Kevin, do you have a base case for later this year in Europe?
Yes. Well, last week, the European 7th sanctions package pushed back a transaction ban on third country transactions for crude, Russian crude. That could be a preview of where Europe actually goes. Right now, Wally Adeyemo, the Deputy Secretary of Treasury, is in Europe to pitch the price cap. It doesn't look as though the price cap necessarily is getting a lot of uptake in the world, but the other option is for Europe to simply say, let's push back and wait.
If I look at climate change and the heat wave, what is going to come is more large heat, large cold, the greater dynamics that we have. Is our grid ready for it, Kevin?
Well, our grid is probably not the biggest concern in the world right now. I think the grid in Europe, for Putin to win on the ground in Ukraine, he's trying to win first on the grid in Europe. But here in the U.S., our politics about electricity are very, very fragile, very brittle. We expect electricity to work all the time, of course, and it's been very, very close. Cryptocurrency shutting down in Texas to make the margin for things to work. Gas prices rebounding on the heat. We can see where the pressure is coming, and it's showing up in the CPI share that goes to utilities and to electricity and gas especially. You're starting to see a significant amount of America's pocketbook going into the wall and I guess to the burner.
Yeah. Kevin, awesome to get your view on things. Kevin Book there of Clearview Energy Partners, and Lisa at the heart of that conversation. A demand response this driving season. Do you remember that report from JP Morgan? They were looking potentially for $6 gasoline.
Yeah.
We got the demand response maybe a little bit earlier than they anticipated.
How much do we see a rebound then in the demand response if you start to see $4 a gallon? What's the price point at which people start to protest versus feel more confident to go out again? In other words, how much further down can prices really go if, as Kevin was talking about, we don't get that refinery response?
Europe, a key part of that conversation too. The politics of energy, Tom, in Europe later this year, it's going to be critical. Both Europe's relationship with the rest of the world and the relationships within Europe. I think the latter is where my attention is, at least right now, Tom, whether they can come together and form some kind of consensus about what they need to do collectively through the rest of this year.
I mean, I know they're way ahead of us in terms of conservation, but I just think this shock, it's a different story here, it's a different story there, John, but I would suggest the shock here is going to be completely wrapped around the changing of season and the fear of that cold, and that's going to happen sooner than later. It's not going to be October. This is going to be literally in weeks.
I'd love to catch up with Wally. You heard Kevin there mention Wally Adeyemo.
Yeah.
I still don't understand that story, Lisa, how you can have some kind of cap on Russian crude. Why are they talking to the Europeans? Don't they need to talk to the rest of the world?
Well,
Isn't that where the lobbying effort really needs to be?
How about talk to Russia? Because Russia came out over the weekend and said, really? You really think that we're just going to say, sure, we'll take gas at 50% lower prices? Like, not a chance. We're not going to do business with you if you try to impose price caps. So where are they going to get the leverage to do this? And as you're implying here, it's China, it's India, and that's a pretty tenuous bet, considering some of the backdrop.
It's a story I just can't get my head around, but I'm open to explanations. Futures right now up 0.5% on the S&P and the Nasdaq 100. We're positive too by 0.5%. Looking ahead to Apple earnings later this week. And Tom, that story, when was the last time you heard a story about cuts to the price of the iPhone? Maybe the cheaper version, sure, but the premium iPhone cuts of up to $89 in China?
I saw that. It's in China, which is a different world, and it's a different market for them and such. What I would say, and this is like Dan Ives territory and others, it's a complete mystery to me how that conference call is going to go. And it could swing either way. The uncertainty around big tech right now is just ginormous.
You don't usually see those sales, Lisa, on top-tier iPhones. No. Maybe the cheaper versions, but not like that. It's interesting.
The big question that I want to hear answered is how much is this a China-specific issue having to do with the lockdowns, and how much is this a broader slowdown in demand for the premium product of Apple?
4 days of discounts on top-tier iPhones in China. Ton of research on Apple going into the numbers. Two concerns, foreign exchange being one, of course, and then the consumer, the strength of the consumer. That's going to be interesting. Throw in China too, and that's an important earnings release later this week. Futures positive on the S&P from New York. This is Bloomberg Surveillance.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las mediciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Fed has to do its job, get inflation down.
The Fed is hiking interest rates into a known slowdown in the markets. This is something that they don't normally do.
We have heard from a lot of companies that they're thinking the following environment is going to be more challenging.
High inflation and policy tightening raises the prospect of a pretty significant slowdown.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures up 0.5%. TK, we've said it a few times already this morning. What a week coming up.
It's a big week coming up. It's sort of a nudgy Monday here. It's a nice time to recalibrate. That's been my theme here. And yes, the Fed meeting, clearly the key thing. John, we'll be doing that show. Remind Lisa that she's doing the show. Okay, very good. We got a great set of guests coming up. John, can I look at 12 months trailing? And the S&P 500 with a recent lift is a correction. It's down 10%. It's not that bad out there. I'm sorry.
We're being supported by lower yields, Tom, but lower yields are down because the data's weak. So what are you going to trade? The weak data? The lower yields? Do you think earnings have been resilient?
Yeah, I think earnings have surprised on the upside. There's a lot of people keeping micro score of this. I think Julian Emmanuel's doing a great job on it, and in others. And the answer is earnings have been okay.
Is Snapchat your bellwether?
It is my bellwether.
Would you say that was okay?
It is. We're going to get to Ms. Hunt here in a moment, and she's heated on that. She says, Snap, can we all get over it? Snap is a bellwether?
Twitter. Bramo, looking ahead to Alphabet, Facebook. They're the heavyweights for ad spend in America and worldwide.
And as you said, 20% of the index is going to report this week, comprised of those 5 names, really, which are going to be coming out scattered throughout starting on Tuesday. How much do we get a sense of the slowdown in consumer demand that is going to affect some of the cash cows of the market that have not been priced in? And honestly, yes, people have been really resilient, and they've frankly shrugged off disappointments in earnings much more than in previous years. How much is this to basically where valuations are versus real optimism baked into something real?
That PMI last week was terrible.
Yeah.
I'm looking ahead to the ISM August 3rd on the services side to see if we get confirmation of that, because that was pretty brutal. Lisa, has anything changed for the Fed this week? 75, teeing up a move in September?
They're definitely going to go 75. That seems to be the consensus across the street. They're basically taking the 100 basis point rate hike off the table. After that, how much guidance can they actually give? What data are they looking at? How much are they actually going to forecast anything at a time when there's so many moving parts?
Forward guidance is dead, Tom.
It is.
Big takeaway the last week, really, for the ECB too.
Please. I thought, there's a key thing out of the ECB. I mean, we haven't talked about TPI. How'd that work out? The answer is it was a very post-ECB.
What did Marcus Ashworth call it, Tom, to protect Italy?
Yeah.
TPI.
That's great.
Ahead of the election in September.
The first thing I looked at this morning was Italian spreads, which I guess are okay, is how I'd put it this morning.
Futures are okay, up 0.4% this morning. Good morning to you.
Lift.
On the Nasdaq 100, up 0.4% also. Yields are higher by 5 basis points, 280 on a 10-year. Crude higher too, up more than 1%, 95.85. Euro dollar 102.33. Welcome back again, Bramo.
Thank you.
Good to have you back, Lisa.
It's great to be back, and honestly, today is not necessarily going to be a massive day, but this week, as we've been talking about, it's going to be a huge game changer on a slew of reasons. The first being these big tech earnings that we're talking about. Alphabet, Microsoft, Meta, Amazon, Pinterest. Why is Pinterest up there? I'm not sure. We also get Apple coming on Thursday. I'm sorry, I'm just going to be honest. I know that Tom really likes Pinterest. Tom, Pinterest fan?
Dow component.
Is that another bellwether for you, Tom?
It is.
Yeah, sure.
Exactly.
All right, let's move on.
Exactly.
Wednesday, we've got the FOMC rate decision and press conference. How much do they talk about not only inflation, the data they're looking on at that front, versus what they're seeing in the unemployment picture? How much can unemployment rise before they respond to that, in addition to just combating inflation? And this is the key aspect when people talk about when the Fed might dial back their rate hikes or even reverse them, which a lot of people in the market are baking in for 2023. And this week, we get a slew of economic data. Interesting on Thursday, that second quarter GDP print for the United States, if it comes in negative, would mean a technical recession, 2 consecutive quarters of negative growth for the United States. We also get that key employment cost index on Friday, as well as the University of Michigan sentiment data. So, honestly, if we look at what the Fed is data dependent on, we've seen both of those indicators weigh the Fed, at least post facto, with respect to their rate decisions. So maybe we'll get some guidance there for the following meeting in September, John.
I'll just be focused on Pinterest numbers later this week.
Good, I'm glad. Me too.
Lisa, thank you. Sarah Hunt joins us now, Chief Market Strategist at Alpine Saxon Wood. Sarah, your line. Wow, this market, like the weather in so many places, don't like it, wait a few minutes, it'll change. Do we have to get used to that, Sarah?
I think that we do, unfortunately. I mean, you've got so many different cross currents that are going on and so many different forces acting on the market that you have these little mini moments where it's all about inflation, and then it's all about recession, and then it's about the Fed, and then it's about the ECB, and then, earnings are okay, so that's all right. I think you're just in a period of volatility because you've got a lot of different things going on right now, and people are focusing on them in different moments.
Sarah, you've got a great single line in your essay on Snap, and the level of Sarah Hunt snark here, folks, is off the chart. Is Snap really a bellwether? Explain the massive divide you see now between substantial and persistent free cash flow companies and the rest of this noise out there.
Well, I think that's really the key. I mean, we've been talking about that since the beginning of the year, that really what you need to focus on is companies that have a business model that's been sustainable through a cycle. Because right now we do have a cycle of things that are slowing. You can argue about whether or not it's a recession technically or whether or not it's a slowdown, but it's definitely a loss of momentum. And we definitely see some problems in all of that. Now, what's the first place you're going to do? You're going to cut advertising, but are you going to cut it from Google first, or are you going to cut it from other platforms first? And that was sort of where I was going with that, is that it's not so much about trying to be mean to Snap. It's just saying that, yes, if you're going to pull back on advertising and companies are going to pull back on spending, that's going to happen. But is it going to happen across the bigger platforms as much as it's going to happen across the smaller platforms? And I'm just not sure that's the case.
Well, Sarah, given that that's your perspective, how much are some of these bellwethers that are the big tech companies going to potentially shift the view in markets, be sort of a pivot point for the optimism that we saw last week going into the recession that so many people expect?
Well, it was interesting because even though Google had good numbers last time, the stock was higher on the numbers and then came down as tech came down. I think you're fighting two different forces, one of which is individual fundamentals for each of these companies, and the other one is technology as a whole versus interest rates and that cycle. And I think right now, technology as a whole is suffering under both the interest rate cycle and what I would worry about on the profitability cycle. But there isn't a lot of differentiation on the investor side yet. And I think that comes as we get further along.
Goldman Sachs has come out and talked about the dollar, the strong dollar, and and how that's going to reduce earnings per share by 1% to 2% in a way that perhaps hasn't been baked in yet to valuations. How do you evaluate the dollar strength up until a couple of days ago and how that's going to factor?
Well, I think that, the faster that the higher the dollar has moved and the weaker other currencies are as much about there being weaker economies than the dollar being stronger. So the real question is, do people worry as much about the currency translation issue, or do they look at the United States and see an equity market that's in better economic shape than some of the other equity markets globally? And I think ultimately that will trump the factor of whether or not the dollar strong is a problem, but it is going to feed into earnings and not necessarily into ways that people have calculated yet.
Sarah, awesome to hear from you. Had a massive week for earnings. Sarah Hunt there of Alpine Saxon Woods. None of us around these tables, thinks that Snapchat or Twitter are bellwethers. But ultimately, Tom, we do have to say, it's certainly sharpened the focus, reinforced the focus on Alphabet and Meta later this week.
John, I just flat out don't agree. I think the size here, granted, Facebook's got its own challenges. I get that. But I think the media conflation of all different types of tech is just way off.
Well, let me be more specific, Tom, since you disagree. Do you disagree with this? The ad revenue pieces of those two companies, that's going to be a big focus for a lot of people.
Yeah,
do you disagree with that?
I agree. Yeah, I agree. And Amazon has their new burgeoning ad business. Joe Feldman wrote about that over at Telsey, I think 5 days ago or so. There are those three big digital players. I get it that they're the future of advertising revenue, if you will. It's worth watching, but there's so much more of a mix here. Look at Apple. Pre-pandemic, John, Apple was barely getting by with $59 billion of free cash flow. I mean, they're just barely getting by. We're modeling on the Bloomberg FA screen, John, $109 billion for this fiscal year ending this autumn. I mean, they're doing terrible.
Cash machine, Tom. We know how well they're doing. Tom, we know that.
Well, yeah, but we equate them to Snap. And I would
don't think anyone's doing that.
I think a lot of people in the parlor game of buy this, hold this, and sell that conflate all that stuff in, and I just don't buy it.
Snapchat and Apple, two companies, Lisa, I don't think either of us would ever conflate.
I'll let you guys work this out off in the break, but I do think that there is an issue here when you start to see the cash cows that we're talking about. And Tom, I'm glad you put that cash flow into perspective. What happens when one of those cash flow companies starts to discount items, not only in China, but plans to start doing it in the United States after basically seeing lines out the door to buy $1,000 products, no problem, just 6 months ago? What happens when Microsoft, also reporting earnings this week, also going to come out perhaps to talk about why they've been reducing their jobs plan, their hiring? How much does this serve as a massive bellwether, regardless of the cash flow that we know they have?
I don't think it's massive. I think it's at the margin, and what we know is if you bring out price of a product, unit sales go up. That's part of the, the elasticities there of price down. Maybe they sell a lot of units in China. I don't know.
I actually think on the hiring intentions headlines we've seen over the last month or so, might be good news for this Federal Reserve. I think that's the goal, isn't it? Just to take some demand away, to take some heat out of the labour market.
John,
I would say seeing those big tech companies pull back on job openings, not on their workforce, but on job openings, perhaps that might be seen as a desirable outcome.
Go with that, John, but like over the weekend, every single conversation devolves back to rent. That, what the Fed is really focusing on is taking the oomph out of the housing market, and that's going to go right into rent, and that's going to keep inflation up in OER.
Stickier for longer.
Yeah.
And that's shaping the debate about how far this Federal Reserve is going to have to go and why Citi and Andrew Hollenhorst are still at 4% year-end on Fed funds.
That's amazing.
I will just say this. Every conversation had to do with rent because Tom tried to sell me an apartment.
I know he did.
To rent over the weekend. He actually
gave you a
brought
tour,
me in.
right?
He gave me a tour and tried to get me to join in.
And spend more money on rent.
Spend more money on rent.
A lot
so
more
that was
money
discussion.
on rent. Futures up 0.5% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Treasury Secretary Janet Yellen says she does not see any sign that the U.S. economy is in a broad recession. Yellen has told NBC that the U.S. is likely to see some slowing of job creation, but said that is not a recession. She also expressed confidence in the Federal Reserve's fight against inflation. Now, the European Central Bank may not be done with big increases in interest rates after last week's half-point hike. Governing Council member Martins Kazaks has told Bloomberg that the rate increase in September also needs to be quite significant. The ECB is trying to reduce inflation that is already more than 4 times its 2% target. Here in the UK, Liz Truss says if she is the next Prime Minister, she would introduce low-tax investment zones to spur economic growth. The Foreign Secretary is leading the polls to succeed Boris Johnson. Her rival in the race, Rishi Sunak, has pledged to crack down on China's influence here in the UK. He calls it the biggest long-term threat to Britain. Elon Musk is denying he had an affair with Sergey Brin's wife, according to the Wall Street Journal. The alleged affair took place in December. The newspaper says it led Brin, the co-founder of Google, to sell his investments in Musk's company. Musk says the story is untrue and that he's still friends with Brin. Brin did file for divorce from his wife in January. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Everyone's looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I actually think that just the right thing to do is to raise taxes right now to take some of the demand out of the economy.
Larry Summers there, always popular. The Harvard University President Emeritus and former Treasury Secretary. I don't think that's going to be popular at all. Futures on the S&P up 0.5%. On the Nasdaq 100 up 0.5% also. Yields higher by 5 basis points, 280.32 on a 10-year. Crude up to 95.60, up 1%. Data out of Europe, not great. German business confidence, soft. Rolling over, sinking. 102.44 on euro dollar, Tom. We're positive there. A third of 1% with one ECB policymaker this morning pointing out that maybe the big hikes aren't done with the first one, and we could get another one in September.
You know, the parlor game front and center today, I just look at the pricing and to see West Texas Intermediate 95.64 is certainly a welcome sign. I'd also know copper, barely have looked at that today, John, but copper, I'm going to call it stasis here, EM sort of stasis on a hot Monday as well. Heat wave may be ending across the East Coast this morning. Emery Horton knows this. She's living it. She's in it. 1600 Pennsylvania Avenue, and joins us cool, calm, and collected this morning. Emery, August is a time where you sit back at the White House and try to figure out the plan for September. What is the plan? What is the urgency to change the bodies in the cabinet and the bodies at the White House?
Well, first, we should know that there's a lack of urgency at the moment for anything at the White House because the president is still in isolation. He's quarantining because he has COVID-19. Virtually, yeah, he's joining meetings and everything virtually, working around the clock, the White House says, more than 8-hour plus days. For September and October, it's really going to be about, and you already started to see this when the president came back from his foreign trips, making sure that he is making this crucial domestic stops because they are concerned about the midterm election. Everything from now on is going to be about the midterm election. You have the House and the Senate also rushing to get a number of bills done before they go on August recess because they know when they come back, everyone is just focused on getting reelected.
I mean, over the weekend, I don't want to get into this right now, but the former president may run, should he announce, before, after, I get all that. Bring that over to the president of the United States. What do Democrats want from their leader?
Well, if you're talking about running for re-election 2024, a majority of Democrats, and this was a poll the New York Times and Siena College did about 2 weeks ago, do not want him to run. They think that there needs to be a new shift in the leadership, and it's not exactly personal, but he would be in his 80s if he was going to be rerunning again for 2024, and they think that there just needs to be a new leadership for the Democratic Party. The issue, of course, you have if the president does come out and says he's not seeking re-election, does that make his presidency an absolute lame duck? But others, like we saw in the Washington Post over the weekend, think that actually it could give his words some more conviction, and then it gives the Democrats to openly talk out loud what you hear them whispering in corners of Washington, which is how to prepare a future bench.
And Marie, given this soup, why is Nancy Pelosi going to Taiwan?
Well, we don't know exactly yet if for sure she is going to Taiwan. She's taking a trip to Asia, and she's supposed to be going to potentially to Taiwan, but the president had said that the military has advised that that's not a good idea right now, and then the fiery rhetoric just continues out of Beijing. This morning, we heard from the foreign ministry spokesman saying they are getting strongly prepared for this visit. She clearly wants to make a stance about standing with Taiwan. It would be, though, quite a political statement. We haven't had a Speaker of the House go to Taiwan since 1997 when it was Newt Gingrich. And at this moment, there is a lot of issues, combative issues between Beijing and Washington. We should also note this is useful for Xi Jinping at the moment. He is struggling domestically with the COVID-0 policy, what's going on with the mortgage rates, a number of issues, youth unemployment, and now he's able to deflect a lot right now on this relationship. And he, of course, has a key party congress coming up in the fall.
When I call this a soup, it's also a soup when it comes to the U.S. relationship with China and also the weather, but having to do with how they're going to deal with tariffs, how they're going to deal with the trade relationship at a time of increasing fraying, as well as a possible partnership between China and Russia that's really ruffled some feathers across the world. Where are we in terms of the tariffs and lifting those on Chinese goods to possibly ease some of the inflation domestically?
It's a great question. We still don't know. The administration still continues to come out and say they're weighing it, but we have yet still no clear decision on what they're doing on not all, but what would be a smaller amount of the Trump-era tariffs, consumer goods like bicycles, sweaters, et cetera, because their number one concern, they say, is inflation. So many on the economic side of the administration say if that is your number one concern, this is something you could do. It won't be a lot of pressure, but it could ease some of that pressure. While you have others in, you know, the trade czar, of course, Ambassador Catherine Tai, and others saying that leaves us with less leverage at the negotiating table. But so far, we do not have an answer. But what we can expect in the coming days, the president had said, is that he has an intention, expects to speak to President Xi Jinping. So maybe some news on that front soon.
Anne-Marie from outside the White House. AMH, thank you. Bravo, to your point, the tension with Speaker Pelosi and President Xi, that's the oldest playbook in the policymaker's book, isn't it? Weakness at home, double down on tension abroad.
How much, though, is this going to benefit versus backfire? And it's talked to, Anne-Marie was talking about some of the military warnings. Mark Milley, who's the chief of the armed forces for the United States, came out and said that Chinese officials and Chinese military aircraft were intercepting U.S. aircraft more aggressively than they've seen in a long time. How much is this aggravating some of the tensions that have been escalating in any case that are going to be very difficult given the conflict already happening with respect to Russia's invasion of Ukraine?
TK, what do you make of this?
What I make of it is everything is about the party Congress. Elizabeth Economy is absolutely definitive on this. And as Anne-Marie said, we are completely fixated on the permanence of Beijing. The Chinese aren't.
The vulnerability of President Xi is something that comes up with Chinese watchers, China watchers again and again, Tom.
Yeah, way below the radar, and it's something we've got to be aware of. I don't have any strong feeling on Taiwan, other than it's been there since my childhood, you know, the whole debate about it. But I think the real focal point has to be on watching China. We've given up doing that because we believe there's a permanence to President Xi. I don't buy it for a minute.
Colin Martin's going to be joining us a little bit later. He'll weigh in on some of these themes from the Schwab Center for Financial Research. Ahead of that, futures up by 0.6% on the S&P and the Nasdaq 100. A lift up 0.5%. Yields a lift up 5 basis points. You sense a theme here, Tom. 280, 32 on 10s. Crude, a lift at 1.2%, 95.86.
My study this weekend is just, do I extend out to Forpal leveraged all cash?
Oh, really?
I'm not there.
Quadrupling down.
Yeah, I'm not there. I just stasis.
How are you the acme of optimism? Quadruple leverage cash, really? And then you're going to tell us it's all about the cash flow of these companies that are doing so well.
I've missed you. You're saying that Tom's position and his view doesn't...
John, Google. I mean, come on. Google. Pre-pandemic, $1 gazillion of free cash flow. Over double now. 74 billion. Wow.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bramo is so excited about Pinterest earnings later this week. She's buzzing.
Oh, yeah.
Big week ahead for earnings. 20% of the S&P 500 reporting across 5 names. 40% of the NASDAQ 100, those same 5 names. Futures this morning up 0.5% on the S&P, and the NASDAQ up 0.5% also. Bit of a bounce back. It continues after a big week of gains last week. The biggest week of gains on the S&P going back to June, about a month ago. In the bond market, we talked about this all morning. It's the growing tension between weak economic data and a hawkish Federal Reserve. Is that desirable or undesirable? The intended or unintended consequence of what they're trying to achieve here. Jobless claims climbing for 3 straight weeks. A really, really weak PMI print last week that we can continue to talk about drove yields lower at the front end by 25 basis points on Tuesday, Thursday and Friday. This Monday, up by 3 basis points. 10's up by 6, 30's up by 8. The curve just getting a little bit steeper. For the euro, more weak data to talk about and more hawkish central bank speak as well. Euro dollar looks like this at 102.48. German business confidence, Tom, terrible. Yet, we still have one policymaker this morning talking up another big move in September. How much weakness is this ECB willing to hike into?
I mean, I'm glad that they're talking it up and they're having visibility, and I guess that keeps it going forward. But I think, John, again, as we've said through the morning, they're as data dependent as I've ever seen 20, 30, 40 years. This is different than 1994. They got to wait for the data.
Which data are they dependent on, Tom?
Their
which
GDP.
Are they willing to ignore?
Well, they're politically hydrocarbons, gas, coal, and all that. But I think it's a much more GDP-sensitive analysis in Europe in war than it is here.
Futures, positive. The euro, just a little bit stronger. That's your cross-asset price action. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Thanks. I'm just going to have a wall-to-wall Pinterest. So rip up the script and talk about how to plan for kitchen renovations. What I'm looking at today are a slew of the big tech names that are going to be reporting this week. Apple shares up 0.6%. Alphabet, Google up 0.7%. Microsoft 0.5%. Not massive. What I'm really looking for this week is how much has already been priced in. Apple has performed the best or the least worst among the big tech firms. How much are we talking about sticky desirability of the iPhone, regardless of the economic cycle, regardless of any price increases? And how much does that news out of China of Apple cutting prices indicate something broader versus a China-specific story? Also this week, we're going to hear from a number of the commodity producers, starting off Wednesday with Rio Tinto. How much do we see the increase in the prices of iron ore, the increase in demand, paired with the slowdown that we're seeing in China, really come to a head with some sort of forecast from Rio Tinto, one of the biggest miners in this area. Those shares up 3.3% today ahead of the open. And Exxon and Chevron reporting on Friday, a very politicized issue, as we were talking about earlier, Tom, considering that the president has talked about price gouging and greedy oil companies. How much do they represent that greediness and profitability at a time when they've already had stellar years, particularly Exxon, those shares up 0.7%, and Chevron up 0.8%, despite the fact that crude on the NYMEX is down at the lowest levels going back to February.
Thanks, Lisa. It's going to be interesting to see the oil as well, but I'm all tech this week. That's what we're going to focus on into the Fed meeting. Right now, with the Bloomberg Total Return Index, the corporate index, the IG index, down 13%. It's a good time to catch up with Colin Martin, fixed income strategist at the Schwab Center for Financial Research. Colin, to cut to the chase, I'm opening the envelope. I'm 3, 4, 5 months, even a year down in my bond portfolio. How do I begin to recover?
Ooh, well, you need time, unfortunately. That's the one thing that we're telling our clients. That's the good thing about bonds is that their prices should recover and accrete to par. That doesn't necessarily help if you're in a bond fund or an ETF, and that's always a challenging aspect because those prices don't necessarily need to rise up. They might not recover anytime soon. That is the challenging part. And what we're trying to tell our clients is to stay diversified. And coming into this year, we did suggest a slightly lower than benchmark average duration. While that might have helped a little bit, but unfortunately, those returns are still down pretty sharply also. But the good news is that yields are pretty high right now. I mean, they're near the highest they've been since the end of the financial crisis. So we think it is an opportunity for investors who have been waiting on the sidelines. And frankly, we know that there are still a lot of clients, a lot of investors who've been waiting for yields to rise, and we think now presents a pretty good opportunity.
Where in the continuum from Apple at 0.5% yield, let's just as example, out to a very distressed energy item not taking part in the energy boom, where in that credit continuum is the best value?
I'll take the easy way out and say probably somewhere in the middle. We do prefer investment grade over high yield right now, and we're okay taking some BBB risk or single A. I mean, that makes up the bulk of the market anyway. We are cautious on the junky issues out there, especially anyone that's distressed right now. We're seeing in the earnings reports right now that earnings are pretty disappointing. We're seeing costs everywhere rise, whether it's labor costs, input costs, and now borrowing costs. So all those things are going to eat into corporate profits, and the demand outlook isn't too strong right now. Meanwhile, we've seen spreads fall pretty sharply over the past week or so, and the value proposition just isn't too attractive right now. With high yield spreads back below 5%, given all the economic risks we see out there, the risks to corporate profits, we'd rather wait for spreads to move up a little bit, for yields to move up a little bit before we got a little bit more excited about high yield bonds.
Colin, let's dig into this a little bit more. We're watching the biggest monthly rally in junk bonds, potentially if this continues, going back to April and May of 2020 when the Fed unleashed its bazooka to try to save markets from the pandemic. How much is this a signal, this rally, of something that's giving the stock market and broader risk assets confidence versus high degree of noise, a lot of investors just taking yields because they haven't seen it in so long?
I think it could be the latter, Lisa. Yields did jump very high, and just on an all-in yield basis, high yield bonds were offering yields close to 9%. And any way you slice it, that clearly is an attractive number, even if the risk outlook is negative. It's just a high number. I think we can point to the Fed also. Over the past month or so, we saw expectations surge about how high they were going to hike. And then they've come down, and that maybe gave the markets a breath of fresh air that the Fed wouldn't necessarily need to hike as much. But we're just still concerned for those confluence of risks that I mentioned before. If we look at previous periods over the past, say, 20 years or so, peaks we've seen with high yield bond spreads, they're well above where they are right now. Now, we don't think we're going to the 08-09 levels, or probably even not the March 2020 levels, but upside of 200, 300 basis points seems likely to us. So we'd be kind of on the sidelines right now and wait for a better opportunity to dive in.
Colin, it doesn't sound like you're particularly alarmed, especially when you try to draw the distinction from what we saw in 2008 and 2009 and the big swings there. Bruce Kasman of JP Morgan earlier said that he's also looking for areas of leverage, not seeing them necessarily in credit markets. Are there any areas in the debt complex that are different, that might have the nodes of something that could be more contagious and more difficult?
You know, we're really not seeing that too much either. Our outlook is, it is more negative because we see risks on the horizon. We expect growth to continue to slow. When we talk about contagion, depth of the recession, we don't think it's going to be that bad. You know, we think it's going to be more mild. That should result in some sell-offs, but not, you know, end of earth type sell-offs or get out of every type of investment you have. So that's the good news. And again, just to reiterate our main point, we do think it should present opportunities, hopefully sometime later this year.
Colin, awesome to get your view on things as always. Colin Martin there, the Schwab Center for Financial Research. Bramo, I spoke to 3 people late Friday. Spoke to Marilyn Watson of BlackRock, Mike Collins of PGIM. I spoke to George Bory of Allspring. All 3 of them said that they think we've seen the highs on a 10-year this year. Mike Collins said for the cycle, over. That was it, close to 350. All 3 of them said that we have not seen the wides of the year on high yield, pushing back against that 100 basis points of spread tightening we've seen over the last month or so.
If you think about it logically, if you think about the credit spread representing the risk that companies face, why would it be contracting? Less risk heading into a recession and a weakening economy. That doesn't make a lot of logical sense. So to sort of edify what they're talking about, that would be the reasoning to push back against that. That said, if the Fed starts cutting rates next year, how much of a support, a reversal does it give to companies who are already well-financed into perpetuity?
You've got to make a call on how much damage is done in between to the economy and what the earnings profile of some of these stories will look like, Tom.
I would look at the damage done in bond portfolios, John. You know, I've been talking about this from day one. You look at the Bloomberg Total Return Index. I just looked at one healthcare name down 22% at the bottom. This is a AAA, not AAA, it's inaccurate, but it's a really high quality name, down 22%. Now it's down only 13%. It takes 5 years of the present yield to make up the drop that you see. Now, granted, that can happen shorter. I get that. But the bond bear market we're in right now, John, is absolutely
There's some real damage done, Tom.
Absolutely original.
All on the same page there. Yeah. TK, is the ECB going to help out? You'll love this. The Latvian Central Bank is speaking a lot this morning of the ECB Governing Council. We will know fragmentation when we see it. Tom, that's helpful, isn't it?
Oh, the great John, you know him so well. Willem Bouter. I put it out on Twitter this weekend, Project Syndicate. I'll put it out again, folks. This is what Bouter's famous for. You know, this is why he's Willem Bouter. He just simply walks through the foolishness of it. And he does it with respect, John. He's not bad-mouthing anybody. It's classic Willem Bouter.
The most effective backstop, Tom, is a backstop you never have to use, right? We'll agree on that.
Alan Meltzer 101.
Willem would agree on that.
Yeah.
They've clearly come up with a tool they don't ever want to have to use, right? Because they're telling us very little about it.
I'm sorry. Willem Bouter just does it great. It's like, I think of Klaus Regling, John, who we talked to at Davos. These guys, they got to be just shaking their head.
Futures up 0.5% on the S&P, on the NASDAQ, up 0.5% also. You know it when you see it. Fragmentation, Lisa. Fragmentation.
Yeah,
you missed a great one last week. You really did.
Political risk. TPI. I like that.
Did you miss that Thursday, Friday?
I did.
I know you were just a little bit jealous.
Oh, yeah.
That you weren't watching that news conference.
Yeah, I was measuring my oxygen levels.
This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve will probably have to inflict much more pain on the economy to get inflation under control after raising rates in June by the most since 1994. Policymakers are expected this week to approve another 75 basis point hike, and they are likely to signal their intention to keep moving higher in those months ahead. Now, the U.S. says that a Russian cruise missile strike on the port of Odessa has cast doubt on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed off after months of talks. Russia says a missile attack targeted Ukrainian military infrastructure. Hong Kong reportedly plans to reduce hotel quarantine for arrivals. According to local media, a two-color health system code will be introduced. One proposal calls for 5 days of hotel quarantine. After that, arriving travelers would be issued with the so-called yellow health code for 2 days that would prohibit them from entering high-risk areas. A Bloomberg exclusive today, the investment bank founded by billionaire Ken Moelis is starting a group to focus on global blockchain deals. Moelis and company is beginning its effort in the middle of a so-called crypto winter venture. Funding in the industry has tumbled. Meanwhile, the price of Bitcoin has plunged to less than 1/3 of its record high of more than $68,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not? I think current signals are no. There might still be a soft landing, but you never know. The percentages change fast. So I think clients need to prepare for different macroeconomic scenarios.
Philip Rickenbacker there, the CEO of Julius Baer. From New York City this morning, good morning. Futures look like this, up 0.4% on the S&P. On the Nasdaq 100, a lift up 0.4% also. Building off the back of the week of gains we had last week. Yields higher by 6 basis points on a 10-year, 281.23. The curve a bit steeper today, higher at the long end on 10s and on 30s too. Euro dollar, positive 0.25%, 102.38. Line of the week so far. Early in the week from Peter Cheer of Academy Securities. Tom, stay out of the heat, read a good book, don't light $100 bills on fire, and hopefully we get more clarity on the Fed later this week.
That is the smartest thing I've heard this week. I mean, I really can't say enough about that. I guess the heat breaks today here in New York.
Hopefully, Tom.
Washington's brutal. Stay cool out there, folks. Right now, we touch on China. Here's Kriti Gupta.
Yeah, we have to talk about, well, China in relative to the bull case for U.S. Treasuries here, because that's been a trade-off that has been at play in the bond market. If you were looking for yield, where do you invest in the bond market? Is it Chinese bonds where you get that extra kind of EM yield premium, or is it the U.S. market where you do have an extremely hawkish Federal Reserve and really take advantage of those interest rate differentials? Well, that brings me to my chart of the day. We are looking at the U.S.-China yield differential. Essentially, when we're looking at a zero line, when the line goes up, it goes over that 0-point line, you do see that there is this kind of extra premium for U.S. Treasuries relative to China. When the line drops down, it's the opposite. And right now, it is hovering at zero. It's a key point, Tom, when we're talking about the bull case for Treasuries, once again, here in the States, at a time when people are perhaps a little bit hesitant to invest in Chinese bonds. Do you stay with the U.S. story, but then at the expense of perhaps lower yields?
Yeah, and kind of China as the nexus for Pacific Rim as well. Kriti, thank you so much. Right now, Andy Curran with us, Bloomberg Chief Asia Economics Correspondent, and there are lots of themes to talk about. Lisa and John are going to touch on that. I want to get out front in July towards the Party Congress believed to be November. This is the 20th Party Congress of the CCP, the Chinese Communist Party. And the great distinction seems to be what will happen with President Xi and the symbolism of a general secretary or perhaps being a chairman as Mao was in 1982. Tell us about those niceties of a party Congress and what they do with their fearless leader.
Well, the party Congress, Tom, is the all-important. Every 5 years, the top members of the Communist Party come together, and it's where, of course, they basically agree on the new government, on the new leadership, the General Secretary and the Standing Committee, and then they push forward for the next 5 years ahead. The difference this time around is normally it was expected that it would have marked the end of President Xi's term, but as you mentioned, all the expectations are he will be getting that third term, which is in recent times quite unprecedented, but he won't be just getting that third term. There will be a lot of language getting codified as well, which will basically be installing President Xi as China's probably strongest, most dominant ruler in several decades. You could argue going back to Mao. Scholars have different views on it, but certainly it will be, as I say to you, it won't be just a new term. It will be enshrining his place in the future development of where China is going under Xi thought, under this new era, and all the rest of it. So it'll be a show of strength, and it'll be quite unprecedented in recent times.
Are the present domestic difficulties in the way of President Xi now? Is there an urgency to fix July to get to November?
You would have to say there is, Tom. Every country has their realpolitik now. Obviously, as we know, with China, it's always hard to gauge what's going on with public opinion, and we know the authorities are in complete control. But going into this year, it was meant to be all about stability. That was one of the buzzwords last year, but they've had several hurdles this year, as you mentioned, of course. The arrival of Omicron has really tested the aggressive COVID-0 strategy. That's hammered the economy. You've had the ongoing real estate slump, plenty of unhappiness among people on all of those fronts. You can judge that by open source social media. And of course, the geopolitical backdrop hasn't at all really improved either. Lots of tension with the US and Europe. So I would say that realpolitik would say, yes, the authorities are quite keen to stabilize things, especially on the employment front and on the economy front, and to build into the Congress on a good base. But I would say, though, it's worth remembering when we do talk about COVID-0, I mean, the authorities also don't want the opposite. They don't want a widespread public health disaster heading into that Congress either. So that's worth thinking about.
And given the fact that housing is such a huge proportion of the Chinese economy, how much is this Congress willing to support the housing market, considering that it has been crashing, there has been issues with the development sector, but it also wants to reduce some of the leverage that's been put into the economy in large part through the housing sector?
Well, indeed. So they've gone quietly under 3 red lines. Last year, when the economy was going well, the authorities thought they had a moment to come in and try and clean up the leverage and the excess risk taken in the financial sector. Homes were meant to be for living in, not for speculating. That was the mantra. But of course, this year, with the economy going the way it is, they're easing up on that crackdown, easing up on the regulation. We are now where we are with the mortgage boycott in 90-odd plus cities and over 300 projects. We are seeing authorities move now. There's some talk we reported and others have reported of a state-backed loan that might be coming to inject money into those troubled real estate developers and companies. And of course, there are other measures being taken to allow mortgage holders a kind of a window of forgiveness until their property actually gets built. It's an unusual feature of China's property market that there is a very high proportion of pre-sale and the mortgages start from the beginning. So the authorities are moving on what's happening on the real estate sector. They're not as focused on leverage. And to your point, they will want to try and put a floor under that before the Congress.
Just real quick here, Enda, do you think the people are overestimating or underestimating how much demand has slowed down in China for some of the basic commodities, especially since that's been one of the factors that's taken some of the heat out of some of these gains that we've seen in prices?
It's tough to call these because there are different views. There are those who say China is now turning a corner with the economy, and obviously that will start to build demand for the imports that they need. There are others saying, look, things are still pretty bad on the ground, and the authorities haven't yet come to the races with a kind of a massive stimulus. So I think it's hard to gauge, but what I would say is the hole in demand in China's economy right now feels very real.
Enda, thank you. Enda Karen there of Bloomberg. Enda, always great to catch up with you late into the evening in Hong Kong. Lisa, if you're going to deliver 3% GDP growth in a country like China, that's going to come with problems. We're talking about some of those problems.
And they're massive, and they're on the heels of the zero COVID policy. How much have we baked that into some of the slowdown that we've seen in the demand for gas, and I think of gas meaning oil prices and then gasoline, but also with respect to iron ore and some of these commodities that have absolutely surged? How much do we see a reversal of that as the demand softens on an ongoing basis in China?
Many people have that 3 handle for this year, Tom. I just went on ECFC for China this year, 4%, 4.0%. Is the median estimate so far.
Yeah, the rule of thumb has always been 6%, maybe a little bit under that 5.8%. It's simple, John. They got to fix COVID. That's where every discussion starts and ends. It's just
How do they fix it, Tom? What with? They don't want the mRNA vaccines,
based on the medical pros we've talked to, they've got to, find a way to save face and get mRNA vaccines in there big time.
The other news this morning, we'll stay on top of this for you. When do you hear of this? Top of the line iPhone 13 Pro. On sale in China for 4 days, $89 off. You don't associate that with Apple often. From New York City, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus Omicron variant still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What the Federal Reserve wants to see is that there's a trend down in inflation.
They understand that there's nothing that could damage their credibility more than sustained inflation.
Policymakers in the Western world are going to need to do more, unfortunately, to bring inflation down.
We see this broad environment where economic growth is slowing.
Things are starting to slow down more materially than maybe what many in the markets are thinking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene back together again. Thrilled you're with us on radio and television. An eventful week to a Fed meeting. And then after that Fed meeting, an important measurement, John, of GDP. Within the GDP report, a measure of inflation, we go from a negative 1.5% to 8%. The survey, 7.9%. That's trouble.
It's the path to September, Tom. That's what Wednesday is all about. We're looking for a 75 basis point hike. Will that be the last 75 basis point hike of this rate hiking cycle? Before you get to September 21st, that's the next Fed meeting after this one. You've got two CPI prints. You've got two labor market reports, Tom. On the latter point, will we start to see some weakness emerge there after 3 weeks of seeing jobless claims in America start to inch higher?
Well, you look for every tea leaf to come in here, and as we've said through the morning, we're all as data dependent as we've ever been, really worldwide as well. But John, I just don't see how the story changes coming from 9-ish% inflation down to, let's say it comes down to 7% inflation. That's miles of work to be done.
Begs the question, Tom, how much damage needs to be done to GDP in between then? This could be a second consecutive negative GDP print in America. You'll get a ton of pushback about whether that's a real recession or not, Tom, based on what's happening with the labor market. But to your point, if we settle down at 5-6%, then the Fed's got more work to do, hasn't it? And what we've heard from the likes of Citi is that more work to do means a 4 handle on Fed funds, not 2, not 3.
JP Morgan gets to a positive statistic, Lisa Brown, once they do so through a one-off on exports, including maybe a nascent recovery in China. We're still pandemic adjusted, aren't we?
We're pandemic adjusted when it comes also to the inflation that we're looking at, because a lot of this does have to do with supply chain disruptions. About a third, if you take a look at some studies that were presented to the ECB in the past few weeks. How much does this color the Fed's view versus not, versus a Fed that is not looking for nuance? It is looking for inflation that is too high, and they are still worried about the Volcker-esque picture of having to deal with inflation that doesn't come down. And then if they don't get it down far enough and they ease off, what happens if they lose all credibility?
Lisa, I know you've caught up after Nepal and Kathmandu. Can you tell me what you see in the credit markets? We missed auction chat. What's happened to the dynamics of credit?
It was tough climbing up to the hills of Mount Everest. Honestly, we've been looking at a rally that's been dramatic. I leave and everything pops higher. And that seems to be the theme. Last week was an incredible rally in credit. This is poised to be the best month for riskier credit in the United States, going back to March, April, May of 2020, when the Fed was really stepping in with some of their survival programs. How much are we looking at a dead cat bounce, as we were hearing about earlier, versus something that's more sustainable, given the profile of these companies that have financing for years out to come?
John, we're deep into July. I mean, we're picking on Lori Calvasina today just because she seems to be the one, but it's absolutely amazing how strategists not are micro adjusting, but just trying to keep up with the guesstimates in the news flow.
4,200, the new price target at RBC. Lori came down from 4,700. Tom, this is a big week for earnings this week. Those 5 big tech companies make up 20% of the S&P. They make up 40% of the NASDAQ 100. That's where you get a really clean read on what's happening with ad spend. That's when you get a clean read of what's happening with the consumer, Apple, what's happening with FX, big multinationals, the translation from foreign currency back to the US dollar. And Tom, ultimately, maybe some insight into what's been happening in China as well. And we know that's not been great.
Well, the China question is really open. I'm with Jay Pulaski on that, but we'll have to wait and see. John, to me, the data point of the last 72 hours of trading, and this goes back to the, for your Emmy consideration, folks, what John did on the Real Yield Friday was breathtaking. The real yield really came in last week from a 0.6
How do you say that with a straight face?
Into 0.47%. The 10-year real yield is a positive number, but I'm sorry, it made some headway back to the zero level.
We're starting to see the intended consequences of Fed policy, Tom, as you start to get that positive real rate. They wanted to see a slowdown in housing. We're seeing evidence of that. They wanted to see job openings come down as evidence of demand maybe just softening a little bit. What they don't want to see, Tom, is that happen all at once, really, really fast and in a way that they can't control. Will we be confronted with a wall of economic data much more sooner, quickly, than they're anticipating?
The Bloomberg Surveillance booking team, cool, calm, and collected here into a busy week for us. There's no time off. Let me tell you, folks, it's extraordinary. The interns have really saved our butt this week. And the bookings into Friday, I can't say enough. When's the Fed meeting, John? Wednesday? Wednesday. I can't say enough about the quality of the bookings for the Fed show. You're going to love it. Matthew Desock gets us started strong here. CIO fixed income strategy at Merrill and Bank of America Private Bank as well. Matt, how close are we to this strange word I haven't used since time began? Restrictive? I get accommodative. It's part of our generational DNA. How close are we to restrictive?
Getting closer, anyway, definitely getting closer. We'll see another 75 this month is our expectation on Wednesday. And then probably at the next meeting or two, by the end of this year, we'll be into restrictive territory. And Jonathan actually stole some of my thunder, hit the nail on the head earlier. The Fed's policy is working as expected. And while we're not actually seeing a decrease in inflation, Tom, as you pointed out, we're seeing all the leading economic indicators rolling over, jobless claims higher, consumer confidence down, yield curves gone from flattening to now inverting. All of it is telling you, it's really giving the market actual confidence that inflation will come down. And that's hard to believe because the market's been wrong-footed by inflation numbers and by Fed communication, to be fair, for over a year now. But you're definitely in the sense that the market senses a slowdown across consumer activity, particularly on the housing market. Again, all the data is coming in telling you that inflation, which is a lagging indicator, tells you what happened, not what's happening now, what's going to happen, should be decelerating quickly. Now, the Fed's going to have to see that to adjust policy, but they will be restrictive by the end of this year, in our opinion.
Matt, when do you think that weaker economic data becomes undesirably weak? What would that look like, and where would you look for it?
So we think we've got a while to go. We're still at, 3.6% unemployment or so. Our forecast is from Bank of America Securities for a mild recession, that unemployment rate moving up to 4.6 or so over the next year. The Fed is going to be able to deal with negative economic data. So unemployment rate moving into the mid 4%, high 4%, even 5%. Unless they actually see the whites of inflation's eyes, unless they actually see it decreasing, we think they're going to tolerate a fair amount of economic weakness, which is not our projection, but we do think they've got a fair amount of ability to handle significantly higher unemployment, because again, there is, as Tom put it, there is a long way to go from 9.1%.
And Matt, perhaps this
use the 1970s as a lesson. Sorry, go ahead, Lisa.
Well, no, I was just going to say that, and I'd love for you to continue, but Matt, this is the reason why people are saying that perhaps we've seen the peak in the 10-year yield, because the weakness that we would have to see in the labor market, in the economy, to achieve what the Fed is looking for is substantive and would lead to much lower growth going forward. Do you agree we've seen the peak and that we're only going lower on longer end yields?
So we had this conversation last time. We had the view, I forget last time we talked, either March or April or May. We thought the 10-year was going to consolidate in that low to mid 3% range. And the clues we looked at was the yield curve flattening from 160 basis points to flat. That was the 2s, 10s. And we saw future Fed rate in 2023. And that was sort of our framework for looking at that. That has not changed. We still believe we're in that consolidation range. And future Fed cuts have only increased. There's now about 4 Fed cuts priced in after they actually hit the peak of 3.5% or so next year. So it's absolutely the case. It's absolutely possible that we have seen the high in 10-year rates. We wouldn't say that for certainty. We never say anything with certainty, because there is still a chance that the Fed is behind the curve on inflation. And if the 1970s is any example for us, coming into the 70s, core inflation was about 1.5%. Then there was an inflation spike. They got to about 3.5%. Then there was another inflation spike, and it got over 4.5% as an average. When Volcker raised the Fed funds rate to 20% 3 times in 1980, he only got core inflation back to 4% for the rest of the 1980s. So it never got back to the 1.5% level it started at, or the 3.5% level. It stayed at 4% core inflation for the 80s. So that's just an example that getting inflation back to where you started can be quite difficult. So if that's the case, then the Fed might have to do more than the market currently expects. The market says about 3.5% as the peak on Fed funds at the end of this year. If the Fed has to readjust to get above 4%, you could certainly see another spike higher in 10-year yield.
And we get whipsawed by all of that all over again. Matt, thank you. Matt Dizok there of Merrill and Bank of America Private Bank. Lisa, that's one more name to the long list of names I've got now, who are basically calling potentially the higher the 10-year yield for the cycle for the year last month.
And a lot of that has to do with the idea that the Fed is going to get what it wants, which is much slower growth. They're going to tolerate pain, and then they're going to be able to start cutting rates as inflation does go lower. And the threat to that really is the Volcker-esque type of 1980s inflation that so many people don't think is what we're facing right now.
So what are financial conditions doing easing over the last month?
Thank you, John. Thank you. I looked at it 3 times this weekend. Way under standard deviation grim. It's a better statistic in my optimism.
Bloomberg's Gowrie Gurumurthy pointing out what's happening with triple C's, Lisa, the junkiest of junk.
Oh, yeah. Rallying. People just piling in.
The first monthly gain this year, the biggest in 20 months.
Yeah, here we go.
Unreal. Futures up 0.5% this morning. Good morning to you all from New York. This is Bloomberg.
Hey,
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Treasury Secretary Janet Yellen says she does not see any sign that the U.S. economy is in a broad recession. Yellen has told NBC that the U.S. is likely to see some slowing of job creation, but said that is not a recession. She also expressed confidence in the Federal Reserve's fight against inflation. Now, the European Central Bank may not be done with big increases in interest rates after last week's half-point hike. Governing Council member Martin Kazaks has told Bloomberg that the rate increase in September also needs to be quite significant. The ECB is trying to reduce inflation that is already more than 4 times its 2% target. Right here in the UK, Liz Truss says if she's the next Prime Minister, she would introduce low-tax investment zones to spur economic growth. The Foreign Secretary is leading the polls to succeed Boris Johnson. Her rival in the race, Rishi Sunak, has pledged to crack down on China's influence here in the UK. He calls it the biggest long-term threat to Britain. A Bloomberg exclusive today, the investment bank founded by billionaire Ken Moelis is starting a group to focus on global blockchain deals. Moelis and company is beginning its effort in the midst of a so-called crypto winter. Venture funding in the industry has tumbled. Meanwhile, the price of Bitcoin has plunged to less than 1/3 of its record high of more than $68,000. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound.
Okay.
And that crack is a sonic boom.
Yeah.
I think the way they got a date was to impress the females by making loud booms.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Looking for another rate hike this Wednesday.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
The right thing to do at this point in time is actually position yourself for a little bit of patience in your portfolios and have those higher cash levels and perhaps take advantage of the higher relative rates that we're seeing in the front end of global interest rates.
Jerome Schneider there of PIMCO. Good to catch up with him on Friday going into the weekend. Coming into this week, looking ahead to the Fed decision and a ton of tech earnings. Futures going into that positive by 0.5% on the S&P, a lift on the NASDAQ of 0.4%, a lift in Treasury yields as well. Curve steeper of 6 basis points on a 10-year, 281.23. Jim Bianco of Bianco Research with the quote of the month so far. Easily. This year's inflation has peaked as last year's inflation is transitory, Tom. Jim making that point to us last week.
Well, that's the dynamic of price, and of course it's something that's affecting all of our listeners and viewers as well, and that's why this conversation is critical. Stephen Englander is esteemed in foreign exchange analysis. He is flat out the best cross-rate strategist in the world. He joins us now with Standard Charter. Steve, your view is an outlier. We go to 3.0%, and then we stay there for something like 5 or even 6 quarters. If we get a Stephen Englander outcome way below the gloom that's out there, what does that do to the certitude, the belief in a resilient and strong dollar?
It's going to damage it. I think that the market is waiting to see clear signs of a recession. I mean, the signs are powerful, but not definitive yet, and they're waiting to see some sign that inflation is coming off. We think all of that will begin to occur in Q4. And, we think the Fed will call it quits at that point, that they sort of say, look, we're going to wait and see where inflation goes until, before we keep on hiking.
What size of big figure move does that mean for the dollar? I mean, are you looking for 5 or 10 big figures of euro strength off of your 3.0% and stay there U.S. call?
Mostly, yes, but mostly in 2023. I think 2022, there's still some risks that, that the, profits stay weak or look weak and that the equities come off. We're still not sure what's going to happen in China or what's going to happen in Europe over the winter. So we think the risk on trade is going to be harder than the market thinks over the last week. But 2023, I think, will be a weak dollar year, and 5 to 10% is perfectly reasonable.
So 5 to 10% isn't necessarily 10 to 20%, obviously, but this is a big differential when it comes to how much some of risk assets can rally on the heels of that. What will be the driver here? Is it euro strength or is it dollar weakness more broadly in the face of more optimistic sentiment in risk assets?
I'd say it's the second. I think the key thing is to get some evidence that inflation is coming down, and notwithstanding some of the pessimism. What we've seen is that wages are lagging, so there's no sort of red-hot labor market pushing up inflation. Real wages are falling like a rock. We're likely to see some of the, demand destruction leading to price falls in energy prices. We're already seeing that, even in things like cars and some other goods. I don't know that this inflation is going to be permanent, but I think the outlook over the next year is actually pretty good. And I think that once the market sees that, it's a risk-on market, both hands.
Steve, it's incredibly lonely. I mean, everybody's out at 3.5%. And John, help me here. We're out at 4% at Citigroup. You mean some of
the Fed funds year end? Yeah,
these are huge differentials, folks. I really can't say enough about it. What do you say to people that are convinced they're just going to keep going and going and going? What will be the damage to their portfolios, Steve?
Well, look, I think a very famous economist once said, everybody's got a plan till they get punched in the face. And right now, we haven't seen the downside on the economy. Labor market numbers look okay. There's no big unemployment. We think that pickup is coming. And when it comes, the pressures on the Fed are going to be different. And the Fed itself, it's not even, sort of responding to a shift in the political climate. It's the idea that if the unemployment rate is going up, it means that demand is below supply. And every model they have tells them that means inflation comes down. It could come down a little bit quicker, it could come down a little bit slower, but it means that they've sort of got themselves on the track that they want to be. Having gotten on that track, why keep pushing it? Since the big uncertainty, if you're at the central bank, is not what the neutral rate of interest is, because they don't have a clue and nobody's got a clue. The big uncertainty is how fast the economy is responding to the tightening of monetary conditions and how fast inflation is going to respond to that. And only time will give us that answer, because we don't have any good models for that.
Stephen, given the last point that you made, that we don't have any good models for this, can you give us a sense, in your history, strategizing about markets, how uncertain this scenario is, how much of a lack of a conviction you have over a dollar call at a time when the dollar has really been one of the most difficult calls to get right?
Well, it certainly has been difficult to get right, but right now everybody's got dollars. And, the market's very long. I can't think of a currency that's long versus the USD at this stage. And I think that what you're seeing is not evidence that the U.S. economy is better in some ways than everybody else. What you're seeing is indications that the world is such a scary place that the only currency asset you want to hold is dollars. I think once those fears recede, the dollar is very vulnerable. And again, it's a 2023 story. At one point, we had thought this might be a 2022 story before the Russian invasion. It wasn't the case. But I think you have to see continued, a terrible world continuing for dollar strength, to keep going in the way it has been.
Steve, awesome to get your view on things.
Stunning.
As things evolve over at the team at Standard Chartered. Steve Englander there of Standard Chartered. Over the weekend, Eric Robertson putting out this note, Tom, the title, Fools Rush In from Standard Chartered and the team over the weekend.
It's absolutely fabulous. And folks, this is what surveillance is all about, just hugely divergent opinions. To have Ed Yardeni come up here is even better, John, but to have Englander with a 3.0-ish and the others, not others, but some strategists out with 100 basis point differential out to 4% or even higher. This is fascinating.
It comes back to the same thing, Tom. How quickly does inflation come down? That's it, isn't it? Isn't that the dividing line between the two groups?
That is the mechanism, that's the process to watch, yes, but wrapped around it is how quickly does the economy slow and a central bank adjust.
It's certainly, Tom, that divides the equity strategist without a doubt. This Thursday, we get GDP. Lisa went through the numbers. Bank of America, TD, Deutsche Bank, Nomura, all looking for a second consecutive quarter of negative growth.
And we get Pinterest.
In America. And Pinterest Friday.
That's Friday, yeah.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Lisa just so fired up about Pinterest this Friday. Won't stop talking about it in the commercial breaks. Tom, she thinks it's a bellwether for ad spend.
Yeah, I want to redo my sync.
Futures positive 0.4 on the S&P, on the Nasdaq up by 0.4%. Big week ahead for tech earnings coming right up. Big week for the Federal Reserve as well this Wednesday. 75 basis point hike expected. What will it mean for September? Yields now up 7 basis points, higher by 7 basis points on a 10-year to 282. Euro showing some strength. Dollar just a little bit of weakness. Tom, euro dollar 102.34.
Right now, this is perfect, John. And thank you to our great booking team for doing this as we've talked to Andrew Hollenhorst and others. And moments ago, a stunning conversation with Stephen Englander of Standard Charter. We find someone to talk to with some perspective. Edward Yardeni is president of Yardeni Research. That barely describes his years of work from C.J. Lawrence and on, and we're thrilled he could give us a moment of time here in a most uncertain summer. The great gap, Dr. Yardeni, is Stephen Englander saying the Fed will stop at 3.0% and others out at 4%, or dare I say even 4.5%. What a divide. Explain the debate of that divide and where you fit into it.
Well, I guess I'm in the range of 3% to 3.25%. So I agree with the economists that
Stephen Englander, yeah.
Yeah, to Stephen for sure. And the reason for that is I think what has to be factored in is that quantitative tightening, which means the reduction of the Fed's balance sheet, has a tightening impact. It's equivalent to some rate hike. The Fed hasn't really produced any estimate of that, but I would say it's at least 50 basis points from quantitative tightening. And then there's a strong dollar, a 10% increase in the dollar since the beginning of the year. I think that's at least 50 basis points. So there's a tremendous amount of tightening already going on from these two developments. And so I'm not convinced that we're going to have to see 4% or higher.
Are these rate increases nonlinear? We had an original one of 7.5%, and now we're going to 75 basis points, excuse me, and now we're going to have another one. This one's got a lot more wallop to the system, doesn't it?
It does, but the financial markets, I think, have discounted it. The financial markets are not going to be surprised by 75 basis points at this one or the next one, quite honestly. I think it's pretty well anticipated. I think the other thing that's very important to look at is what we're constantly focusing on the Fed funds rate. We really have to look also at the longer end of the marketplace, particularly the mortgage rate. I think that's where the tightening really has been extraordinary. We've seen this basically a doubling of the spread between the mortgage rate and the 10-year bond yield. And that's kind of put the brakes on anything housing related. We're seeing that not just in housing activity, we're also seeing that in housing related retail sales. So I think that's where the Fed has already accomplished what they wanted to accomplish, which is to put a lid or at least break some of the demand that's contributed to inflation.
Yeah, the only problem is, Ed, that a lot of this is supply side driven and it's not trickling in just yet, at least not in the numbers, to lower inflation. We haven't necessarily seen peak inflation because we haven't necessarily seen a drop off in any material way. How much does this factor into your belief in a soft landing or challenge it if the Fed is hiking, tightening, and you're not seeing a response in inflation?
Well, you nailed it. I mean, that's really the issue is if inflation just remains persistent, protracted, then obviously the folks who are saying the Fed's going to have to kind of do a Volcker 2.0 are going to be correct. I think there's already some signs. I'm obviously reaching for whatever I can find, but I'm looking at the regional business surveys, and both New York and Philadelphia surveys for July, so they're very current, are showing that prices paid and prices received indexes are in fact starting to moderate, as are their indexes for supply chain disruptions like backlog of orders and so on.
Okay, but Ed, there also are other surveys that show that a lot of companies do expect supply chain disruptions to continue for the years to come, and that's accounted for about a third of the inflation so far. Basically, all of this, trying to put it together, you came on the show a couple of months ago and you said you still believe in a soft landing, you still believe in the strength of the U.S. economy. Have you shifted at all?
Not really. I think that clearly we're going to have a negative real GDP number in the second quarter this week, so we'll have 2 negative quarters in a row. But as you know, that's really not an official recession. I think it's a mild recession at best. I think it's a mid-cycle slowdown, kind of consistent with what we had in the mid-1980s and mid-1990s and mid-2010. So we've seen this before. Consumers are in good shape. The corporations are in good shape. So no, I don't see a hard landing.
Ed Yardeni, how is the equity market linked to this, and particularly where you and Steve Englander are of 3.25%, dare I say 3.5%?
Well, you know, it's never easy to pick a bottom in stock markets, but I'm going to give it a try. I think that on June 16th, when we fell down to 3,666 on a closing basis, which, by the way, was 3,000 points higher than the intraday low that we had in 2009, making a bottom. I think that was the bottom. And coincident with that is we have seen commodity prices coming down. We have seen a slowing in the economy, which I think will help to moderate inflation. And the real question is going to be the earnings season. And so far, the earnings season is going reasonably well. It hasn't really trashed the stock market. The stock market's held up quite well.
I've got that at 10:22 a.m. on June 16th, just for people to single point where Ed Yardeni is on a bottom to the market. Ed Yardeni, we talk here about what a chairman will do with the Fed. What will you look for in the press conference? He's got to come out and frame what he does after a presumed 75 beeps. How does he do that?
Well, I think he's going to find his inner Volcker. I think he's going to come out very tough on inflation. I think we're going to find that the word inflation appears numerous times. And I think he'll make it very clear that this is the Fed's priority now. It's quite a shift from what we saw before following the initial pandemic effect in August of 2020. The Fed changed the priorities and made it clear that bringing the unemployment rate down was the #1 priority. Now they're doing it again. Powell is the great pivoter, and he's pivoting again towards the notion of the Fed has to do whatever it takes to bring inflation down.
I love it, Ed. The great pivoter, and he's finding his inner Volcker. Fantastic ways to color the moment that we're in. How much do you view the 60-40 as still being viable if we've seen the bottom, as you're saying, in the S&P, but also are looking at someone who is finding their inner Volcker heading the Fed?
Well, when you say 60-40, you're talking about a bond equity portfolio?
Yes.
Yeah. Look, I think in line with this scenario of mine, I think 3% is the right rate for the bond market. I don't know that you're going to make a lot of money with a drop in bond yields, but 3% is back to normal. And that's a pretty good return. That's one of the reasons that we've seen valuation multiples come down so hard in the stock market, but they have come down, and they're kind of fair value as long as we don't have a hard recession. If we have a hard recession, then you want to be 60 in bonds and maybe 40 in equities.
And I've got to squeeze this in. Can the bond vigilantes in Europe make a comeback? Or will TPI stop that from happening?
Well, yeah, I think the ECB is going to give the best try here to avoid fragmentation and support Italy, for example. So I think they have come back, and it's a big challenge to the ECB.
Ed, your world of bond vigilantes. Ed Giardani there of Giardani Research, taking it back a long time when Ed came up with that one, Tom. How many years ago was that?
It was a long time ago when there wasn't a bear market like this.
Sure.
Again, and Ed lived it. I mean, 78, 79 pre-Volcker was really something, and that was a walk in the park compared to where we are right now.
In many ways, the week begins tomorrow, not today, when we get earnings from Microsoft and Alphabet. Facebook Wednesday, Amazon and Apple on Thursday. Lisa went through all the economic data we get through this week as well, Tom. Then you've got the Fed sandwiched somewhere in between on Wednesday.
We're trying to make Monday eventful as well. And, you know, I think there was some really, I think without question, the conversation this morning with Stephen Englander. I mean, how many people disagree in the game with Steve Englander? And the answer is 7 out of 10. Maybe 6 out of 10?
I think we're pretty divided, Tom, down the middle at the moment, to be honest with you. We go back to that 9 handle on CPI.
Yeah.
Many people saw that and said that was the peak, Lisa. Others looked at it and said, well, I see evidence of this being stickier, staying with us for longer.
This is the toughest market I can imagine. There's so many different facets, and factoring into the supply side constraints, it's many different areas of the supply side market. The idea that it's not just China and supply chain disruptions there, it's shipping lines, it's people getting sick, it's very human and it's very disparate. How do you connect all of these dots and get an economic picture? And that's why I think earnings actually will be the most interesting, followed by that employment cost index. How much do we see that rolling over as an indication of something that perhaps is a deflating in this inflation bubble?
Do you think Chairman Powell lays out the road towards September?
No.
Or avoids it completely?
Avoids it completely.
John,
Is that the goal on Wednesday?
I think so.
Yeah, John, I just looked at August 10, the ECO screen. We don't have a year-over-year CPI, core, et cetera, study yet. But it's amazing how the month-over-month first look really comes down.
And then September 13th, the one after that, Tom, and Jackson Hole somewhere in between.
Comes down.
You're looking for a pause or something, Tom?
No, I'm just
looking for a road trip.
Looking for a road trip.
For
Jackson
our
Hole's
viewers,
confirmed. We're going to that too.
For our viewers and listeners, John, what's the difference between 7% inflation and 9%? I would suggest nothing.
What's the difference for this Fed? I would suggest they've got to keep on going, whether it's 7, 8, or 9. Coming up, we'll catch up with Michael Kushma of Morgan Stanley Investment Management. We'll talk to Anna Miletti of Allspring and Peter Chi of Academy coming up at the 9 o'clock hour as well. Why he thinks we could get that recession sooner and why it could be deeper and more uglier than people expect. Peter Chi of Academy. Join us at 9:30. Bramo will make some notes and double down on them.
Of course.
And then come back tomorrow and tell you all about it.
She's got the carousel projector.
Lisa, I missed you. It's great to have you back.
It's great to be back.
Alongside Tom Keene, I'm Jonathan Ferro, ahead of a big week here stateside. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve will probably have to inflict much more pain on the economy to get inflation under control after raising rates in June by the most since 1994. Policymakers are expected this week to approve another 75 basis point hike, and they are likely to signal their intention to keep moving higher in those months ahead. Now, the U.S. said that a Russian cruise missile strike on the port of Odessa has cast doubts on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed after months of talks. Russia says a missile attack targeted Ukrainian military infrastructure. Tesla has increased its capital expenditure plan to as much as $8 billion a year. That is according to its latest quarterly report. The report also disclosed details about another subpoena from security regulators relating to Elon Musk's tweet about taking Tesla private. The company has said it is cooperating. And it's a big win for Intel and for Washington's goal of increasing semiconductor production at home. Intel has secured one of the biggest customers yet for its year-old contract chip-making unit. It will make chips for the Taiwanese company MediaTek, whose chips are used in Amazon's Echo speakers and Peloton's exercise bikes. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Underground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon. Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is not an economy that's in recession, but inflation is way too high. And, the Fed is charged with putting in place policies that will bring inflation down. And I expect them to be successful.
The Secretary of Treasury of the United States, Janet Yellen, there, speaking the message on NBC this Sunday. Right now, Lisa Bramwitz and I are thrilled to give you a different view. It's been a really intellectually interesting Monday here at Surveillance. We've had some optimism out there. We've had a lot of measured views of a measured recession. Noah Rubini flat out doesn't agree. He's Chief Executive Officer of Rubini Macro Associates and joins us now here and will continue on radio into our next hour as well. I have talked about Willem Bouter's rigor this weekend and looking at TPI, which, to cut to the chase, he thinks is complete folly as well. What was it like when you walked in his office at Yale University decades and decades ago?
Well, he was the one who hired me at Yale, so he has been a great intellectual friend, always rigorous, very opinionated and so on, and mostly right.
You too, and mostly right. You too, the gentleman from Netherlands and the gentleman from Istanbul in Italy, you too have an old world view. What is the old world view of this recession, this slowdown that we're in, where maybe it's a mega threat, as your new book is called, this new world, it's all going to be fine, is off the mark?
Well, now the consensus view is becoming that hard landing is likely as opposed to a soft landing. But now people say, well, be short, shallow, mild, plain vanilla, garden variety. I beg to disagree. I think there are many reasons why we're going to have a severe recession and a severe debt and financial crisis. Debt ratios are at historically high, 420% of GDP in advanced economies and rising. Lots of zombie corporation, household, government, financial institutions were bailed out during COVID. This time around, we're tightening monetary policy. During the 70s, we had stagflation, but debt ratios were low. After the GFC, we had a debt crisis, but the inflation was falling, deflation, because it was a demand shock and you had a credit crunch. This time we have stagflationary negative aggregate supply shocks and debt ratios that are historically high. And in previous recession, like the last two, with massive monetary and fiscal easing. This time around, we're going to go in recession by tightening monetary policy with no fiscal space. So the idea this is going to be short and shallow, it's totally delusional.
Out of their COVID disaster, can China come to the rescue? If we see resurgent Asian growth, does that help us?
Well, if China were to grow faster than otherwise, that would help everything else equal. But until November, until she is reelected, be a source of growth for the global economy.
A lot of people look at the lack of leverage, at least financial market leverage, akin to what we saw leading up to the 2008 crash, and they say that alone will allow this recovery to be quicker and allow the downturn to be more shallow. Where do you see nodes of leverage that could be unwound or be unwieldy that could actually cause what you're looking for?
Well, first of all, there is leverage in the corporate sector. Debt ratios are very high for some subset of the corporate sector. It's true that banks now are not as leveraged because after the global financial crisis, they deleveraged, but there's been a rise significantly of the debt and the leverage of the non-bank shadow financial system, leverage loans, CLOs, and you name it. And those spreads are already widening, and there could be a shutdown of them, of those markets, if you have a severe recession. So I would say corporate first, then shadow banks, Many sovereigns are in trouble. And there is half of the household sector that has low income, is fragile, has a lot of debt, not much wealth, and in recession, risk of unemployment. So even the household sector is divided.
In the past, the financial sector has led the economic sector. You've seen the financial meltdown, and in some people would say caused, right? And I'm thinking about the 2007, 2008 bust, and then the 2009 recession. Is this time different? Are we going to see the economic downturn before the markets wake up to the reality that you're talking about and start to respond in suit?
Yes, the economic downturn this time around is going to lead to severe debt distress. I would say you're going to see parts of the corporate sector going bust. You'll see the parts of the shadow banking system going bust. You'll see the household sector that is partly fragile going in trouble. You'll see some sovereign going in trouble. Yeah, the trigger for the financial distress is going to be a recession, and recession is not mild, shallow, but it's going to be severe and protracted, and there'll be then a vicious cycle between the real side and the financial side of the economy.
In this stagflation, do you believe what so many guests on this show have said today, that we have seen the peak in 10-year yields for this cycle?
No, I expect that inflation is going to remain persistently high. There are actually medium-term forces going to lead to stagflation over time. Protectionism and deglobalization, reshoring of manufacturing from low cost to high cost, aging of populations, restriction to migration, decoupling between US and China, global climate change, cyber warfare, new pandemics, backlash against inequality, weaponization of the dollar. People are not thinking about the medium term. In the medium term, I see in my book about at least a dozen different types of stagflation and medium-term shocks. Going to keep growth low and cost of production high.
We're going to continue this on radio, but I got to ask one question for our television audience and for those worldwide that really, really listen to Noel Rubini. Have you ever been this gloomy before, or is it a different gloomy?
Well, it's a different gloomy. I was gloomy right before the global financial crisis.
You and I sat in Davos. Come on, we sat in Davos over a beverage, and you absolutely nailed that. That's why people are listening now.
Well, I think in some sense right now is worse because in the 70s, as I pointed out, we had stagflation, but debt ratio were low. So there was not a debt crisis. There was one in Latin America. And after the GFC, we had the debt crisis, but we had the lowflation and deflation. I think that this time around, you're going to have the confluence of stagflation and of a severe debt crisis. You'll have a stagflationary debt crisis, so it could be worse than the 70s and post-GFC.
We're going to continue on radio with Dr. Rubini, and I want to make clear he will not be a stranger, and of course, an important book coming out. It's a kind of book where if you're an optimist and you flat out disagree with Noel Rubini, you still got to read the book to frame out your thoughts to push against mega threats. We'll see that, I believe, in October. Lisa, what's great is Noel just sold the movie rights. It's great.
Well, you know, he laid out a pretty gloomy scenario. He almost makes me sound rosy. At the same time, there is a lot of legitimate argumentation in all of those points that are important to consider, whatever your view, simply because we are seeing a sea change with respect to supply chain disruptions, with respect to the deglobalization or regional globalization, or however you want to call it. There are some big changes happening, and how do you factor these out into a new environment for price increases as well as monetary policy?
And what's so important about this, and I put Rubini and Bowder together, and also with the great Stephen Roach as well, is one of the rare Americans, and it's interesting, they're all out of a Yale complex over the years, but they're very balance sheet centric versus income statement solutions. It'll be interesting to see how that plays out. This was a really informative Monday. I thought it was going to be a snooze fest. Wrong on that. Some really interesting stuff to think about. Diving into the week, and of course the week is to Wednesday, and an important meeting, the Federal Reserve. We'll do our special coverage in the afternoon as well. Stay with us. This is Bloomberg.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Let's get this week started. Live from New York City this morning. Good morning, good morning. Futures doing okay. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. It's a monster week for markets.
The big week.
We've got earnings season. It is big tech earnings coming through.
Big tech earnings. We have the Fed meeting.
Chairman Powell.
A lot of data coming up.
Second quarter GDP. We've got the Michigan survey the week ahead.
One of the most important weeks in the market.
It's really about the outlooks.
Apart from the earnings, I think we'll then find another data point.
Growth, the persistence of inflation.
You have the same headwinds we've had for most of the year.
I think it's going to be difficult all summer.
It's difficult enough right now. Joining us is Morgan Stanley's Michael Kushner and Miletti of Allspring Global Investments. And let's begin with you. This Wednesday, if we get 75 from this Fed, is that the final 75 basis point hike of this cycle?
No, I don't think it is. I think the Fed is determined to do more to prove that they have inflation under control. So I think the market anticipates more than 75, but they certainly only anticipate 75 this week.
Michael Kushner, you at 75 this meeting, it's 75 again.
Certainly 75 this meeting seems baked in the cake. And the next meeting will depending slightly on the inflation over the next couple of months. Up till now, the inflation data has been disappointing. There's been no real signs of inflation ameliorating, such that if we don't get that downshift, the month-on-month numbers don't start downshifting to 0.5, 0.4, I think we'll get 75 in September. But I think 50, 75, it's skewed to 75, but it's possible we get 50 if we get some relief on inflation.
Well, and let's talk about the road to September. The meeting is on September 21. On August 10th, September 13th, we get CPI prints. August 5th, September 2nd, we get payrolls prints. Is it the labor market that allows them to do more, or inflation that forces them to?
I think it's going to be a combination of both, Jonathan. I do think the numbers are going to start to trend down. Hopefully we saw the peak inflation number. I'm never going to bet on that. But I think we probably have, given what we're seeing with energy prices and other things. And so market looks like to be anticipating that as well. If we see that, we're seeing jobless claims also increase, which tends to lead what we see in the unemployment rate. So the data is showing a slowing in the economy. That's why you've seen this 8% rally since June. The market is, counterintuitive in some ways. It looks like we're getting what the market needed from the Fed. The real slowdown is happening with the rate increase.
Michael, Anne mentioned it. 3 weeks of jobless claims climbing. It's not just jobless claims, it's the PMI as well, coming in sub 50 on the services side. Really, really weak stuff. We see the weakness in housing. We've seen people start to pull back on job openings. Michael, a question I've asked a few times over the last few weeks, how much of that is desirable from the Fed's perspective, and how much of it is undesirable?
Well, I think that the slowdown in hiring, has to happen. We're downshifted from last year to this year, 500,000 plus last year to 300,000 plus this year. But from what I understand, equilibrium stable unemployment is down around 100,000 a month. That's just for stable employment, a stable unemployment rate. So that has to keep downshifting in order to get that relief on wage front medium term, if we're going to get back to anywhere near that 2% inflation target over the medium term. So I think that downshift has to happen. What you don't want to see happen is that jobless claims numbers go to like 300,000.
We don't want to see that anytime soon. Futures right now up a third of 1%, about 25 minutes away from the opening bell on the S&P. We are higher on the Nasdaq. We're up a third of 1% also. Mike McKee will be in that news conference, as he often is. He joins us right now. Morning, Mike.
Good morning, John. Take a look at the calendar going forward. Everybody's focused on this Fed meeting on Wednesday, but I'm going to argue that Thursday and Friday are going to be even more important for the markets, and here's why. The Fed is going to do 75. The Wall Street Journal didn't come out today with any different prediction, and that's the way the market's set up going into it. But what about after that? Jay Powell is going to be very circumspect about what he says going forward, because we don't have an answer to the question of are we in or going into recession, and we don't have an answer to is inflation slowing. They're somewhere in the middle. So at this point, we're going to be watching that data to see if that makes a difference to the Fed. If Jay Powell says we aren't sure yet, we're open to whatever, then the market's going to have to decide. A lot of people leaning towards this recession question. There's no definition called a technical recession, and the NBER numbers don't suggest it at all. You take a look at the left-hand side of this chart of the measures that the NBER uses, and you can see a recession. Take a look at the right-hand side. You don't see a recession in that yet. We haven't seen a big fall off. So we've got to look at the data to see where we're going to end up. Now, the markets are at this point thinking that we're going to see a 50 basis point move for the last meeting for the meeting at the end of September. But that could change easily as the data change. So let's check on Friday, especially with the ECI, wage price spiral. Spending and wages still going up, and the PCE numbers show us inflation or not. There's an awful lot going on in the markets that they're going to have to pay attention to, and I think that's why it's going to be more important than actually what the Fed decides. We know what they're probably going to do.
Mike McKee, we got a flavour of this over the weekend from Secretary Yellen. Are you suggesting that we might be spending Thursday morning potentially disagreeing over what is and what is not a recession?
I suspect that'll be the case on Wall Street, because there are people who are convinced that we are in recession. Yeah. 2 quarters in a row, we may get declines, contractions, but then there are others who think not yet because of the data I just showed. So it's going to be an interesting debate going forward. And we get to do it all through August. That's the great thing.
Can't wait.
Until Jay Powell speaks at Jackson Hole.
Mike McKee, thank you. Looking forward to the Jackson Hole coverage alongside you as well. On Thursday, when we get that GDP print, we're not expecting a negative print. The median forecast is not looking for that in our survey, but a few banks are, individually. Bank of America, TD, Deutsche Bank, Nomura, all looking for a second straight quarter of negative growth. Michael Cushman back with us. Michael, can you tell me how you think the market might respond to that?
Well, I think that the market is expecting weak economic data. Wouldn't be surprised at all if we got a negative print. And of course, it's very difficult as you get close to zero or around zero. A lot of these sort of volatile numbers like inventories, trade data, which is very difficult to forecast, becomes a key factor, whether you're minus 0.5 or plus 0.5. And what I really focus on is domestic demand. Now, how is domestic demand moving? Is incomes rising, incomes falling? That will support the economy medium term, but whether it's minus 0.3 or plus 0.3, I think is relatively moot.
Are we already seeing the recession trade? And can I ask that of you? Given what's happened at the moment with this rotation we're seeing away from the inflation trade, cross-asset, we've seen that develop over the last month or so. Do you think we're starting to price that a little bit more?
I think we're starting to price.
That was Fran Meletti. Go on, Anne.
Sorry. I'm so sorry. I think we started to price more of a normalization of growth. Certainly, probably a shallow recession leading us to normalization, but not in any way a deep recession or a global recession, Jonathan. So we need to get to normalized growth. And that's what makes this all so confusing. Even when you look at the long-term data, we had outsized growth for a long period of time due to COVID. And no one really knows what normalized looks like anymore. So if you get a little bit of a shallow recession that leads us back into some normalized growth, that actually could be healthy. And I think that's what the market is trying to settle on. So I think we're going to be stuck in a trading range while we figure this out.
They're trying to draw a distinction between pricing slower growth and pricing a recession. It depends where you look. If you look to the commodity market and the drawdown we've seen there, maybe you can make the case that we're starting to price that. If you look to credit, Michael Kushner, I would say typically in recessions you don't get about 100 basis points of spread tightening in a single month. And Michael Kushner, that's what we've had. What are your thoughts on that?
It was quite impressive. I think it really comes down to the thinking that yields have peaked, Fed policy terminal rates have peaked, if not come down. We're talking about 3.5, 3 3/4 just a month ago in June when the Fed moved 75 basis points. That's come way down. Expectations that the break-even inflation rates are coming down. We'll be back at target by the end of 2023. A lot of good news has come in to support the idea that we won't have to have a big recession. The slowdown we're seeing will be enough to generate a stable Fed funds rate or cuts in Fed funds rate in the first half of next year, which is bullish for riskier assets.
So, Michael, let me put you on the spot. I caught up with Marilyn Watson of BlackRock, Mike Collins of PGIM, and George Bory of Allsprings on Friday, late Friday afternoon, and I asked all three of them whether they thought we'd seen the high on the 10-year yield for this year, potentially for this cycle. All three of them said yes. Then I asked them whether we'd seen the wides of the year on credit spreads on high yield. All three of them said no. Where do you stand on those two questions?
I think there is a high probability we've seen the high in 10-year treasuries this year, that we peaked at that week in June when the Fed surprised everyone by raising rates 75 basis points. We got to 360, something like that. I think that even if the market thinks Fed funds is going to 4, that's going to lead to a bigger recession, which will cap long-term bond yields, at least for now, until we know the true trajectory of inflation medium term, which we won't know till the end of the year or early next year at the earliest. In terms of credit spreads, when we got to a high yield bond yields, over 8% on indexes, that looked pre-recessionary like, not catastrophic recession, not like global financial crisis recession levels, but a more normal cyclical recession. 8% seems pretty high. So I'm hopeful that actually we may have seen the highs in credit spreads this cycle.
Interesting. Michael Kushner of Morgan Stanley and Meletti of Allspring will be sticking with us. Let's get you some moves ahead of the open in about 20 minutes away. We can do that with Kaylee Lyons this morning. Hey, Kaylee.
Hey, John. Well, let's kick it off with Apple because we got news overnight that if you live in China, you could get a discount on an iPhone coming up this weekend. 4 days of discounts on that iPhone Pro 13 model, July 29th through August 1st. They're really trying to spur demand as they deal with COVID zero policy there, which is also affecting them on the supply side with a closed loop system now going into place for Foxconn in Shenzhen. That stock is essentially unchanged right now in early hours. You also have Intel up about 0.5% or so, securing a contract to make chips for Taiwan's MediaTek. That's a step forward in their efforts to compete with the likes of TSMC or Samsung in that foundry business. We also have yields moving pretty substantially higher today, up 8 basis points on the 10-year. That's giving a lift to some of the banks like Bank of America, up about 1 percentage point. We'll, of course, keep that sector in focus ahead of that Fed decision and after it on Wednesday. And finally, on the note of China, I would note, we had reports overnight that they are looking at a fund to support some of those developers in crisis, that lifting iron ore prices, and as a result, boosting the idea that steel demand may be stronger. So U.S. Steel getting a nice lift before the opening bell, John.
Kelly, thank you. We'll catch up with you again before the opening bell as well. Got some pushback against the Secretary Yellen narrative about whether it would not be a recession. Someone just wrote to me, a Bloomberg subscriber, the fact that Secretary Yellen is trying to manage the narrative on recession is probably a good indicator that the second quarter number will be negative. That's one person's view. I know you'll have more as well. Morgan Stanley's Mike Wilson just said this on the equity market rally we've seen over the last couple of weeks. He published over the weekend, of course. He said, with equity markets seemingly shrugging off bad news on the economy and earnings, it may be trying to get ahead of the eventual pause by the Fed. This is the punchline for Mike Wilson. The problem this time is that the pause is likely to come too late. Mike Wilson and Morgan Stanley there. Peter Cheer, I know, of Academy, has got some thoughts on this. We'll catch up with him at about 9:30 Eastern time around the opening bell. Coming up, it's a big week for big tech.
Technology is a great way to sort of play that slowing growth theme. If the consumer is going to stay resilient, but things aren't going to be all roses and sunshine. I think technology is an area you really do want to look at very hard.
Apple results are in the spotlight. That conversation up next.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Spot for Apple. Our concerns are one part is services and another part is China exposure. Never-ending COVID zero is a difficult backdrop for durability of consumer demand in China, which is an important end market, and the stability of production.
Apple doing something you don't usually hear about, announcing a rare discount for top-tier iPhones for customers in China. This coming as China forces major companies, including iPhone manufacturer Foxconn, to operate under a restricted system in Shenzhen to curb the city's latest COVID outbreak. On top of the story, back with us, here's Kaylee.
Well, John, Foxconn is one of about 100 companies in Shenzhen forced into a closed-loop system for a week. That includes the likes of BYD and Huawei, DJI as well, and it really speaks to how COVID zero impacts Apple on both the supply and demand side. On the supply side, obviously, when you have the majority of the world's iPhones being made by Foxconn, that can impact production. On the demand side, the shuttering of the economy leading to a broader slowdown, which could, in theory, weigh on sales in the Chinese market. So Apple, as you say, trying to to make a move to counter that, announcing a rare promotion in China, 4 days of discounts from July 29th to August 1st, about $89 coming off the price of the iPhone 13 Pro and certain AirPod and Apple Watch models as well. But as you say, an interesting move for a company that usually is reluctant to offer any kind of discounted pricing. So why take that step in China? Well, we have to consider it's a very important market for Apple. It makes up about 20% of its revenue. But interestingly, when you take China together with the other international markets in which Apple operates, that's the bulk of its revenue. U.S. revenue only is about 42% of the share. And that overseas exposure also means the company is exposed to serious foreign exchange headwinds, with the dollar hovering around its strongest level in about 2 decades. So I expect we'll be hearing about that when the company reports on Thursday, and probably from the other big tech companies reporting throughout the week as well, John.
Kelly, thank you. Anne Meletti, I wanted to come straight to you on some of this and get your thoughts. I understand you might not be able to comment on the stock specifically, but when you heard that a company like Apple was offering discounts in China on top-tier iPhones, not the cheaper ones, the top-tier iPhone, what did you think?
Well, Jonathan, I think there's a couple of things, on Apple specifically. We know that the launch of their new phone also typically happens in the fall. And so, and when after the launch, they typically give discounts. So maybe it's not that crazy for them to offer discounts a little bit ahead of that, given all of the things that Kayleigh just mentioned, right? The lock-in, the demand pull-in, et cetera, in China because of the unique factors, also the dollar. But the real challenge that we're going to have to continue to watch across the board for all companies is what they're saying about demand. It's been a supply issue that we've all been focused on, and now it's a demand issue. And, look, earnings have been great. Top line up 10% so far, earnings up 5%, but that's not what investors are focused on. They're focused on what management teams are saying about future demand.
And do you expect to get a decent read on that from the 5 big tech names that report this week that make up about 20% of the S&P and 40% of the NASDAQ 100?
I think it could be mixed, Jonathan. And I do think the dollar is going to play a role in terms of profitability.
Michael Kushma, I want to bring up the FX side of it because this story is so important to people in the equity market too. What's the base case for you, Michael, on the foreign exchange side of things?
The base case is that we've reached not to say a peak in the dollar, but it's going to be increasingly difficult for the dollar to continue to rise. Could it rise a bit more? But it's really about Europe in that sense, and the China slowdown. Because right now we're having a synchronized sort of problem around the world. The U.S. economy is slowing significantly. The European economy has slowed significantly. And China is not getting that post-COVID relaxation of restrictions boom because they're continuing to pursue the zero COVID strategy. So there's no sort of engine of growth for the world. And in fact, you look at a place like Japan, and while a couple of months ago, while the Bank of Japan has to give up their zero interest rate policy, they have to tighten policy like everyone else, they didn't do it. The yen gets crushed, one of the weaker currencies in the world. But now, looking forward, as the global economy is decelerating, maybe the Bank of Japan doesn't look so out of step that actually keeping rates steady and not tightening policy may serve them well in the weeks and months ahead.
Michael Kushma, are you suggesting that Operation Ostrich over at the BOJ might actually be a good idea, just to bury your hand and ignore everything going on around you?
Well, if you keep something in place long enough, right, the clock goes around twice, and eventually it becomes the right strategy again because the cycle turns. And I'm not saying that for sure, but it doesn't look quite as bad from a market perspective, consensus view, than we did a little while ago, where people were talking about the Fed as now tightening so much we're going to get a recession in the U.S., and we may not get as much of a slowdown in Japan, and maybe the yen has bottomed in the high 130s.
Michael Kushma, you mentioned China. I want to bring up China too. There's a big situation evolving there with this loan boycott, so-called loan boycott spreading. There are other people who are raising the question that maybe we've got a balance sheet recession on our hands in China. We're not used to a China spitting out 3% GDP growth. Michael, for some people that feels like a recession. How would you describe it?
I think that's true. The property market, which has been a very important contributor to growth in China, has continued to languish, if not get worse, as policy initiatives don't seem to be coming to the forefront as quickly as hoped for. Call it, say, at the beginning of the year, where everyone knew there was this problem in that sector, but it doesn't seem to have been dealt with from a point of view of getting it past the bottom of it and making progress going forward. So that looks to be continued drag, if not indefinitely into the future. So growth is still likely to be well below trend in China, considering that as well as all the other factors. And also have to think about the Chinese currency. It has been tied to the dollar now pretty steadily for the last couple of months as the dollar has risen. It's rising on a trade-weighted basis as well. The question is, will the Chinese currency be able to hold its own if this continues in China?
And so, Anne, final word goes to you. Just for the global equity market, looking at things regionally, geographically, so to speak, do you think the US right now is just the least ugly story based on what's emerging elsewhere?
I think it has been, Jonathan, but I do agree with Michael. If the dollar has peaked, and I think there's a good chance that it has, or it's close, then what has been a headwind for a lot of other countries will soon become a tailwind. And I think that could lead to much more attractive opportunities in emerging markets and other places.
Anne Meletti, Michael Kushner, to the both of you ahead of a big week ahead. Thanks for your time this morning. Coming up, the morning calls, and later, Academy's Peter Cheer joins us at the opening bell, making the case for treasuries with markets underpricing the risk of recession. Why Peter Cheer thinks that recession could be sooner and could be deeper. He joins us in about 8 minutes' time from New York City this morning. Good morning. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Five minutes away from the opening bell here. Equities delivering a week of gains last week, a morning of gains so far. We're up by about 1/4% on the S&P, on the Nasdaq up by 1/10%. That's the equity picture. Here's the bond market story. Last week, Thursday, Friday, two-year yields came in 25 basis points. The why? The data wasn't great. Really ugly PMI on Friday. On Thursday, jobless claims climbing in the wrong direction for the third straight week. Bit of a bounce this morning. Yields higher by 5 basis points on a 2-year, up 9 basis points on a 10-year. You can see that curve steepness just starting to bounce back just a little bit this morning. That's the price action. Let's get you some morning calls. Morgan Stanley downgrading Snap to underweight from overweight, expecting ad revenue to remain soft amid increasing competition and weakening demand. That sharpens the focus on Alphabet and on Facebook later this week. Next up, Susquehanna downgrading United Airlines to neutral, $35 price target, highlighting a challenging macro environment and continuing operational headwinds. And finally, Oppenheimer trimming its Amazon price target to $160 ahead of Thursday's results, expecting consumers to reduce their spending once the summer comes to an end. That stock at 122.88 and up 0.4%. That's three of the calls this morning. Up next, gearing up for a huge week of big tech results. Academy's Peter Cheer warning of a deeper and more painful recession than markets are currently pricing. We'll get Pete's thoughts on that and a whole lot more in about 4 minutes' time. With futures just about positive and fading a touch, we're up 0.25%. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Four seconds away from the opening bell this morning. A brand new trading week just around the corner. Good morning. Futures positive 0.2% on the S&P. On the Nasdaq, basically unchanged. On the small caps, the Russell up 1/3%. From New York, your opening bell just about to ring. There you go. Switch up the board and get to the bond market. 10-year yields look like this. Yields higher, 9 basis points. The 2.8380% on a 10-year. The curve just a little bit steeper here. Last week, 2-year yields lower, much lower across Thursday and Friday. Downside surprise after downside surprise on the data front, and a wrong kind of upside surprise on jobless claims. Pair that with PMIs, and yields were heading south. They're heading north this morning. Euro dollar up 1/3%, 102.48. We've talked about this growing tension between weaker economic data, think of German business confidence, against the more hawkish central bank. Think of an ECB policymaker this morning teeing up potentially another 50 basis point hike in September. Crude bouncing back up 1.6%, and 96 handle on WTI, $96 and about 20 cents. We're about 40 seconds into this with positive 0.1%. Leading the way is energy off the back of that climb in crude. Energy up by 1.1%. Utilities a little bit more defensive. They underperform. We're down 0.2% there. Joining us for a look at the stocks around the opening bell, some single name movers Here's Kelly Greifeld.
Well, you left off with energy. That's where I'm going to start. It's pretty muted reaction to the opening bell, but if you look under the surface, you do have energy front and center. You can see ExxonMobil higher by about 1% or so. You're also seeing some of the basic materials higher as well. That's good for some of the steel makers. We have Cleveland-Cliffs highlighted there. That's up about 1%. If you move down the list, though, it's not as green. You have Twitter down by over 1% just a few minutes into trading. Of course, Twitter had a disappointing earnings report on Friday. They blamed Elon Musk. Elon Musk fired back saying, "I'm rubber, they're glue," on Twitter, the website. I haven't heard that one for a few decades. In any case, Twitter shares down by about 1.6%. And NVIDIA falling along with the other chip makers. You did see Intel sign a very big contract for its contract chip making arm. That's bad news rather for the other chip makers, NVIDIA being front and center there.
Can I just admit that I'd never heard of that particular saying?
Really?
I'm rubber there. Is
You've never been on an American
Is that an American school thing?
That is very popular in about middle school.
It's your words bounce off me and they stick to you.
Exactly.
I had to get someone to explain that to me over the weekend.
There
Katie,
you go.
thank you. Appreciate it. Kelly Greifeld. Looking ahead to a big week ahead for tech earnings and maybe not the schoolyard insults. I'd never heard of that, but okay. Katie Lyons joins us now. Big week ahead, Katie, for big tech.
Yeah, huge week ahead across just the 5 tech names, Microsoft, Alphabet, Meta, Amazon, and Apple. We're talking a casual $7.5 trillion in market cap, or roughly 20% of the S&P 500. So this is a lot of weight that could have the power to move the broader market. Of course, it's Alphabet and Microsoft first out of the gate today. For Microsoft, as usual, we'll be paying attention to that Azure cloud business. With Alphabet, though, the focus really is going to be about online advertising on Google, because if Snap is a reliable indicator, companies are pulling back on that in a big way. In fact, according to some estimates out there, the U.S. digital ad market likely only increased about 11% in the second quarter. That is a steep deceleration from the 58% growth we saw in the year-ago period. So that could impact not just Alphabet, but Meta as well. Meta is actually expected to post its first period of zero sales growth since the company's IPO about a decade ago. And for Alphabet, expected to see the slowest growth since the start of the pandemic in 2020. Meanwhile, Amazon is actually getting a larger share of its revenue from advertising as well, and it's expected to see the slowest revenue growth going all the way back to 2001, up just 6%, a dramatic cool down compared to the 30 to 40% growth we have seen throughout the pandemic. And of course, throughout the pandemic, they spent a lot of money investing in new warehouses, in the labor force. It's looking now like they may have overdone that, and profit's going to take a hit as a result. We're expecting net income to be down about 82%. Now, of course, they're trying to pull back on their workforce, one of a string of companies that is looking at slowing or even slowing hiring or even firing in some places. I expect we're going to hear a lot about that this week, John, in addition to foreign exchange and all of those other big themes we're following.
Did you guys not have that line about sticks and stones may break my bones? You had that too.
Yes,
but
that was the more common one. I hadn't heard of the rubber thing.
The rubber glue thing, it didn't make it our way.
Yeah,
that's all.
no.
It didn't make it down your way either.
It did not.
In Virginia. Okay, good to know. Katie, thank you. PIMCO's Jerome Schneider on more serious things now, telling investors to build some dry powder in portfolios.
The right thing to do at this point in time is actually position yourself for a little bit of patience in your portfolios and have those higher cash levels and perhaps take advantage of the higher relative rates that we're seeing in the front end of global interest rates curves.
Academy's Peter Cheer sounded the alarm on the economy. He writes this over the weekend: "I am clearly in the camp that the recession risk is closer than we think and that it will be deeper and more painful than the market is currently pricing in." Pete, I'm pleased to say, joined us now because I like Pete, not because I want to read this anymore. Pete, I read this over the weekend. It was thoroughly depressing. Can you tell me why you think this is the case?
You know, a lot of what you were just discussing really falls into this. There was a lot of wealth created at these disruptive companies. Those individuals have lost a lot of wealth. I think just as importantly, a lot of these disruptive companies, they were a huge engine for growth. They were advertising, they were buying chips, they were doing a lot of things because it was growth at all costs. And now that there's this fixation on revenue, I think you could see a slowdown from the spending from those people. I think you can see a slowdown from the spending of those companies, and that hasn't been factored in. That's a really new phenomenon. That huge wealth effect that we had that is dissipating very, very rapidly, that to me is what is going to turn what could be a garden variety recession and is going to make it hit us sooner and faster than anyone's currently thinking.
Pete, what are you seeing in the data that supports that view? Are you seeing that yet at all?
You know, we saw the PMIs come down. I think housing to me was one of the leading indicators, right? We wanted to fight housing, mortgage rates spiked. You're seeing nothing but bad data coming out of housing. And as PMIs come down, and you're starting to see anecdotally everywhere you look, hiring freezes, people laying people off, et cetera. So I think it's starting to show up there, and I think that's going to be the big surprise is when within a month or two, all of a sudden we're like, ooh, wow, this was worse than we thought, just like PMIs on Friday.
Pete, that's the intended consequence, perhaps, of tighter Fed policy. Are you seeing any unintended consequences of tighter Fed policy?
Yeah, I think, again, this goes back to, I think things have changed. One, we're way too dependent on finance and leverage and interest rates. So when they hike, it has a bigger impact. I think QE really did help inflate asset prices. QT is going to take that off. And then I do think they're just missing this recent wealth effect, whether it was crypto, these disruptive stocks, all great companies potentially, but there has been this wealth loss. And I think that's really going to get this ball rolling and make everyone very cautious. And it's that accelerant that's the problem, that the Fed is not taking into account, I don't think, in a very good way, because I think they're relying on traditional models and not thinking maybe outside the box enough.
So, Pete, you mentioned the R word. That's what I want to sit on just for a moment. We're often always thinking about where is the leverage. And what I've experienced over the last few weeks, in fact, the last 12 months, is someone again and again and again, people coming on this show and basically saying that there isn't a problem with leverage. Consumer balance sheets are strong, corporate balance sheets are strong. Where's the leverage, Pete?
So I think corporate balance sheets are generally strong, but I think it was these growth companies, right, where you had growth with no, concern about earnings, right? That's been taken off. So I think that was a degree of leverage. And I'm not so sure about the consumers. I think you're starting to see some delinquency show up. It's still at very low rates, but in some of the payments, and many still have moratoriums on student loans, et cetera. I think as those things start coming off, that, again, we're going to see the shock effect. I think we already saw it once on the spending side where people had front-loaded spending. I think that's going to impact their credit, their willingness to spend going forward. So I think these are all really coming together, and unfortunately it's going to come together probably this summer ahead of the elections.
And Pete, you could make the case the bond market's picking up on it. Yields came in pretty aggressively on Thursday, on Friday at the front end. This market, do you think it should focus on just yields coming down, supportive of risk assets, or the why of yields coming down?
So to me, that's a big shift. Is for a while we got away with lower yields meant good for risk assets. And I think the two things that have changed were last year or so, lower yields were really a direct result of Fed policy. So there wasn't an economic reason necessarily, it was Fed policy. So now that yields are going down, but you can really tie it to economic concerns, I think you have to take cash flows down, so those should balance themselves. Again, I'm very worried about this disruptive technology stock where you had this ability to rise through anything. If you ran out of money, you could get more money, whether it's Series B, Series C, SPAC, IPO. That's been cut off for a lot of these companies, right? You're seeing valuations come down. You're seeing a big divergence, I think, between where companies think they should be valued and where private equity wants to contribute more. And that, to me, is a form of leverage.
So, Pete, tell me where you're bearish, much more so right now, because this equity market's rallied off the lows of June. Credit spreads have tightened aggressively off the wides of June. Where are you most bearish?
I'm probably most bearish, again, in these disruptive and big tech. I think they've had a really nice bounce. It was a great bounce. I think a lot of hedges got taken off. And I understand why we all want these to get back to where they were. It's, they're appealing. There's great growth stories. I just think that that's where the excess keeps getting pumped in, and that's going to keep kind of getting deflated. So we go through this, we blow it up a bit, we deflate, and every time we kind of get to new lower lows. So that, to me, is where I'm most concerned. I'm pretty good on credit. In fact, I like senior quality credit. I like CLOs in particular at the senior tranches. I think rates are fine. We'll bounce around a little bit, but I think the highs of the year are certainly in. I buy yields. And I think we can take a little bit of a look at some of the commodity stocks because they've been beaten up pretty hard. So really, to me, it's going to be this big tech disruptive that, again, I want to take some of the air out of this recent rally.
Pete, how do you think the policymaker is going to respond to the situation that you think will evolve, will materialize?
What I would like to see is them become really data dependent and really force home on Wednesday that they're concerned about recession, that they're worried about that. What I'm seeing, though, is I think Treasury Secretary Yellen just came out saying she doesn't see a recession. The White House just published a blog trying to redefine what a recession is. So that tells to me there's still political pressure leaning on this inflation. And I think they've gone too far on that. So I could get very, very bullish if the Fed makes it sound like they are really going to balance this recession risk. If they come in all in on inflation, ignoring recession risk, then I think it's another big lay down for stocks.
It sounds like to me, though, Pete, that you think the forces have already been unleashed, that there's not much the Fed can pivot to, that it's too late. Would that be right?
I think they still have a shot. This week, if they really correct it, I think some of these forces have been moved. I don't think we're bouncing back to the highs anytime soon, even if they act well. But they have to start acting now. I think you go through this, you've got another month and a half or to the next meeting, and that's going to be too late.
How do they pause, though, Pete? With inflation still close to 9, 8, 7, 6, even if we get to the end of the year and it's 5 or 4, don't they have to keep on going?
I don't think so. I think you're seeing commodity pressure ease, you're seeing some supply chain issues ease, and you're seeing consumer spending drop. So we've got to be forward-looking, right? Plus, a bunch of the hikes that they've already done are only starting to work their way into the economy. Traditionally, we always thought it was 3 to 6 months. I think that's been accelerated, but I think they should give this a pause and see where things come out, because I think they've been too, telegraphed, too aggressive, and they were so far behind the curve, maybe they even missed the curve. So I think they should really pause and watch this data.
Pete, we're all trying to trade the Fed pause. I know so many people are. Pete, one thing that hasn't come up at all, really, is when we look at lost decades, you can find them in the United States. You can find them on the NASDAQ. Of course, we're used to talking about them in Japan. Is there a risk here that even if the Fed pauses, Pete, that we could face the same situation in US markets? And I only ask that because it's never asked. Pete, we always think about the Fed pausing, we're off to the races again, here we go, another bull market. Is there a risk here that that could be the case? That we enter this new market regime that, sure, even if you get a Fed pause down the road, you don't go back to what we used to have?
Yes, I agree with that. I think this kind of world of deglobalization or globalization is kind of ending. So I do think what we need to see real growth and real upside to the markets is this kind of reshoring. I think Yellen called it friendshoring. We've been talking about the concept of working with countries that are closer to you, and we need to rebuild our supply chain. We need to become energy independent again, fully energy dependent, both on sustainable as well as traditional energy, and those would be the catalyst for growth. And I think that's what it takes for me to get really comfortable that we can, avoid this sort of lost period of time. Otherwise, if we keep kind of getting lost in our own politics, not making good policy, not redeveloping our supply chains, I think we're going to kind of wobble around for a period of time.
Pete, you're going to stick with us to work through some of the data we're going to get later this week. I want your thoughts on that GDP print this Thursday. Peter Cheer there of Academy Securities. Coming up, President Biden taking somewhat of a victory lap.
Gas prices are coming down. In fact, gas prices have fallen every day this summer for 38 days in a row.
That conversation up next.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las mediciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Gas prices are coming down. In fact, gas prices have fallen every day this summer for 38 days in a row.
President Biden speaking on gasoline prices in a virtual meeting as he quarantines with COVID. Average prices at the pump have been falling every single day since its peak in the middle of June, still 32% higher than it was at the beginning of this year. Joining us now from D.C. is Anne-Marie. Hey, AMH.
Hey, John. Yeah, the president really wants to make sure the public knows that prices are falling. If you look at his latest tweet on his Twitter handle, he does just that, and he keeps updating it. And right now, what we do have is gasoline prices hovering around $4.30. Gas Buddy actually says that prices across the nation are more closer to $3.99. So this is good for the president. Remember, this continues to come up in polls that inflation is the biggest concern. And then one of those big reminders, of course, is gasoline prices. You see that every single day if you're American driving in a car or walking across a gas station. The issue, though, Jonathan, of course, are the risks that are attached to it. Can the prices continue to fall or stay at a relatively average level that the president deems is acceptable ahead of the November midterm elections?
Anne-Marie, thank you. Mike McKee, ahead of the GDP print later this week, and we've already heard from Secretary Yellen over the weekend, Mike McKee, about whether they would or would not call that a recession. Mike, can you just frame what's going to happen this Thursday when we get that GDP number and how you think people are going to respond to it?
Well, people are going to look at the number, and those who think we're in recession could make an argument because we're likely to get either a contraction or a gain that is so small we really don't notice the difference. And then everybody's going to look to Friday and the prices, and the question is, does the Fed keep raising rates because prices keep going up and then push us into recession? One of the problems is we're not going to see the decline in gas prices make it into the PCE numbers this month because it all took place in July and it's going to take place into August. But you look at that gas chart again and you can see mathematically inflation is going to go down because gas prices are going to go down. It also has a psychological effect, not just the political aspect that AMH was talking about, but also the fact that people may feel like they can spend more money on other things now if gas prices keep going down, which would contribute to GDP. Now, here's something interesting. We aren't going to see gas prices reflected in this, but take a look here. The Philadelphia Fed and the New York Fed's latest indicators, the Philly Fed Index and the Empire Index, show that inflation, prices paid by companies, went down over the last month. And then that Michigan number, which sent the Fed to a 75 basis point the last time, has gone down. People think inflation is starting to fall back, and maybe that's because of gasoline prices. So there are some indications that maybe the Fed is doing enough on inflation that it will come down, and they maybe don't need to run us into a recession. The question is, where is that point?
Mike McKee, thank you. Looking ahead to the data this week, and of course the Fed Wednesday and beyond. Looking at GDP on Thursday, the estimates so far for the second quarter, positive 0.4% off the back of a negative 1.6%. The consensus view is that we get a positive view. That's the median estimate. But there are some banks out there looking for a negative print. They include Bank of America, TD, Deutsche Bank, Nomura, all looking for that second straight quarter of negative growth. Peter Cheer, I promised you we'd bring you back in to the conversation on this particular topic. Peter Cheer, of course, from Academy. Pete, can you just walk me through how you'd respond to that as a market participant if we got that negative print this Thursday on GDP?
So I'm not overly concerned about a negative GDP print. I think we might get one. But the first quarter, it was really inventory related and export related. So I'm not too worried about that. I'm going to be much more focused, I think, on the housing data. And really, for me, it's actually going to be earnings. I don't typically pay this much attention to earnings, but I want to hear what these big tech companies have to say. Are they still seeing that spending? Because I think that is going to what drives us for the next 2 to 3 months, not what happened the prior 2 months. So I think that's big. I do think this fixation on a few cents here and there on gasoline prices has just become almost insane, and we've got to be thinking about the bigger picture. I think the average consumer is much more aware of everything that's going on, and I think this housing price, if that starts coming down, we see weakness there, that's yet another reason actually for consumers not to spend, right? I believe that 60% of American households own their home. I'm much more afraid as they've kind of deflated that to the point that that starts impacting then a few cents here or there on gasoline. So I think politicians directing the economy fixated on one metric is a recipe for disaster ultimately and leads us to the wrong conclusions.
Pete, from what I heard this morning about driving and the demand season, it's meant to be peaking. Here's summer driving season in America. From what I heard about that this morning, it's because prices are so high that people have stepped back. So that's already having the impact, and that's perhaps why prices have been coming down. Pete, I'd love your view on tech. You mentioned it briefly. Which names, where specifically, and what spending? Is it cloud spending, ad spending? What is it?
I think I just keep looking at what were these disruptive companies doing? What did they need? They needed semiconductors. They needed web services. They needed all these things, and they were able to spend pretty aggressively because they did not have to worry about the next round of cash flow. If that's what I want to see, or is that now following up into the bigger companies who are selling that into those disruptive companies? So that to me is going to be the triggering point, I think.
Peter Chair of Academy Securities. Pete, great note this weekend. Even though it was very bearish, I enjoyed reading it, as always. Great work, Pete. Just awesome. Looking ahead to a big week ahead. Big morning for some people over at Morgan Stanley. Let's get you some breaking news. Here's Shonali Basak. Hey, Shonali.
Hey, John, you have a big move over at Morgan Stanley. That's the co-head of equities trading departing. That is David Russell, who has been at the bank for nearly 3 decades. Remember, Alan Thomas and Gokul Laria are still at the bank. They are overseeing this business. Morgan Stanley is the biggest equities trading shop on Wall Street. In recent quarters, remember, however, John, Goldman Sachs and JP Morgan have won a lot of share, and in some quarters are actually even coming in above Morgan Stanley in that business. So there's a lot of pressure on this team. There have been a lot of changes internally within the equities division. This has been a Morgan Stanley lifer, essentially. In the memo that Bloomberg's Sridhar Natarajan had picked up from Ted Pick, who oversees the total business, they had really said he's worn the Morgan Stanley blue jersey for all of that time. But eyes now are on Gokul Laria and Alan Thomas, who will be leading this business, who were elevated in 2018 alongside David Russell to run this business and are just facing a very competitive time ahead.
Shonali, looking forward to your coverage of this developing story this morning. Shonali Basak there, our chief Wall Street correspondent. Coming up, your trading diary. What a week ahead we've got for you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Coming up to 26 minutes into the session, just about positive on the S&P 500 here. It's a mixed session. We're down about 0.2% on the Nasdaq. Big week ahead for the Nasdaq. Here's your trading diary on the week ahead. You'll hear from the president twice today. First at 12:30 Eastern, then again at 2:15 this afternoon. Big tech earnings kicking off with Alphabet and Microsoft on Tuesday. A Fed rate decision and Chairman Powell news conference Wednesday. US GDP and jobless claims on Thursday, followed by earnings from Apple and Amazon. And we round out the week with PCE, the ECI, University of Michigan Consumer Sentiment, and all of the above. From New York, thank you for choosing Bloomberg TV. Looking forward to the week ahead and covering that with you. This was the Countdown to the Open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look. in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010 after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.